In Dubai. Here are the top stories we're watching. Jamie Dimon's hurricane warning. The JP Morgan CEO warns investors of an unprecedented combination of challenges to the U.S. economy. Coming off the boil, oil prices drop after a report Saudi Arabia may boost production. OPEC Plus meets today. And Israel kicks off its first hiking cycle in over a decade. Don't miss our exclusive conversation with the Bank of Israel Governor Amir Yaron this hour. Well, the feed-through from the U.S. and from Asia was negative on the equity side, but the reality is it was the ISM manufacturing data in the United States that was stronger than economists had forecast. The Jubilee Bank holiday, the FTSE 100 contrasts, that's going to be offline. So a little bit lighter liquidity as we go into this trading day. We're called higher on the futures, and going into the open now as we kick off, we expect a little bit of that momentum to be maintained. Wells Fargo out with a fresh note saying they see a rise in the probability of a recession in the second half of the year, potentially persisting into 2023. Watch some of the European energy stocks as well. They're expected to come under pressure. Oil, both WTI and Brent came off the boil. So the stock 600 energy complex looks vulnerable as we look at some of these intraday movements in the next few seconds, up 25% so far this year. That is the best performing sector so far. But this is the state of play at the moment in Europe, and we'll see how enduring some of these moves are as we get our head around sentiment and flows. I want to flip the board, though, and get you the cross-asset check as well. This is a story of equity futures that are holding on to a little bit of a positive line at the end of the tunnel. 0.25% on the S&P 500 mini. US 10s at 291.13, spiking overnight. The yield curve flattens. Traders are raising those bets on the path for rate hikes. The Fed balance sheet reduction, all of that weighing. Your Euro Swissy comes into focus with some of these Swiss inflation data. Now, that was a surprise. Swissy on the front foot at 102.23. And then Brent crude, we talked a little bit about that. This is a story. This is actually just about one question. Are the Saudis going to pump more oil to make up for lost Russian barrels over the next few weeks? That's maybe going to be part of the reason the U.S. president is going to be there as well. Let's get now to the Oaktree founder, Howard Marks, because he spoke to Bloomberg about the market attitudes, and he sees a better investment environment, actually, for bargain hunters.
Attitudes are more balanced today, but you know, when there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. Now the prospective returns on many asset classes are higher than they were just a little while ago, and again, a much better climate for the bargain hunter.
The Oaktree Capital co-chairman Howard Marks there on potential opportunities emerging in the market. This as officials from both the dovish and the hawkish wings of the central bank stay the course on tightening. JP Morgan's Jamie Dimon, he's weighed in. He's now warning investors to prepare for an economic hurricane that's ahead. Let's head out to Giulio Renzi. Richie, he's the head of asset allocation for Europe at Vanguard. Giulio, you had a chance to listen to the commentary. Which side are you on the Marks or on the Dimon side? What are you telling clients?
Well, of course, the situation is quite challenging at the moment for any type of investors. Of course, investors that are looking for the medium to long term in order to allocate their resources, but also for those that wanted to be a bit more tactical. There is a lot of volatility in the market that is creating, of course, challenges. What we see are opportunities, as it was mentioned earlier, especially on the equity side. There has been a large correction in some stocks, especially in some countries. And those corrections led to valuations that now are way more attractive, that would benefit investors that have a view of medium to long term, especially in some areas. And here we're mostly talking about countries and geographies that have their valuations being more favorable, like, for instance, emerging market equities and European equities as well.
I want to just take a quick look at what's happening with U.S. Treasuries, because we're back above 290 for U.S. 10s. The markets live team is actually spending some additional time in terms of seeing where that trade goes and whether we're going to get an inversion around the 210s curve. Is that going to follow suit, and what does it mean for some of the asset classes broadly?
Sure, there is, of course, a risk that, I mean, the yield curve is an indicator, is one of the potential indicators of the risk of a recession. That's not our base case scenarios. I think that most of the monetary policy, especially in the US through the Fed, has been priced in. So we are expecting the Fed to increase rates by another 150, 200 basis points by the end of the year. But that has been mostly priced in by the market at this point. So this is actually creating, also for investors that want to be diversified, some good opportunities. What I mean by that is that, of course, they can invest at higher yields through the bond market, and that basically shifts the entire efficient frontier for diversified investors upward, so they can get higher returns for a lower level of risk. And that is good, generally speaking, for any investors that wants to be diversified and wants to keep their risk aversion and risk allocation constant.
I mean, until about 3 weeks ago, most of the input that I got from some of the big investors was, it's really hard to hedge at the moment. Didn't matter whether you were in bonds or in stocks or whatever else you were, everything was being sold off. The correlation between bonds and stocks is now getting back into its traditional structure. Within the European spectrum, where do I find the opportunity at the moment? Is it in stocks or is it in bonds?
Well, within the European sectors, I think that there are good opportunities in the equity side. The central bank is a bit behind the curve compared to the Fed. So there are more probabilities of a European Central Bank to be hawkish compared to the Fed, and that could create a bit more pressure over the very short term on bonds. So we tend to be a bit more bullish on the equity side when it comes down to Europe.
What about energy prices? Brent crude coming under pressure. It sounds like the Saudis may step up in terms of oil production. That has not been confirmed by the government at this point. But let's assume that scenario does take shape and the losses hold. Is that enough of a reprieve for European central bankers, for the ECB in particular?
Well, that's for sure something that they're going to take into account, and they're going to monitor very closely. The central bank, I think, one of the main concerns, the European Central Bank, one of the main concerns for them right now is to keep track of inflation. And what I mean by inflation, I mean inflation on services. That tends to be one of those indicators that, historically at least, has been stickier compared to inflation on goods. And that, just more recently, has started picking up. And of course, that creates a bit more fears for the central bank, or also additional challenges on how to blend and to manage that, given the fears and the likelihood of recession in the new year term.
How do you factor in some of the currency volatility, especially given that, you know, again, there's this tendency to write off the greenback, and then it comes storming back into the room, and everybody's got to go back and revise some of their forecasts. Is it going to go even higher from here? Are we in for a surprise?
Well, on the US dollar, we think that because of the expectations that are already priced in on the bonds, that we're not necessarily expecting US dollar to go much higher than that. I think we are reaching a point that it's almost there. So there has been a large appreciation in US dollars, and we think that we're near the peak, if not at the peak. Of course, other currencies and other countries in other markets, especially in emerging markets, the situation is quite different. If we're looking at China, there are some good news coming up from there in terms of COVID and restrictions, and that is actually alleviating some of the pressure and some of the fears associated with growth in emerging market countries.
Giulio, hang on to some of those ideas. We're going to flesh out your other views. That's Giulio Renzi-Ricci, the head of asset allocation for Europe at Vanguard. Let's get you a bit of a snapshot of what else is to come on the show. Meta, second in command, Sheryl Sandberg, steps down as CEO after 14 years. We look into what it means for the future of the social media giant a little later on this hour. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Welcome back to the Open. We are, of course, in the middle here of the European trading day. This is the state of play with the Stocks Europe 600 up about 1/3 of 1%, kind of steamrolling over the negative feed-through from Asia and the United States after we got the ISM data on the economic side that suggested maybe the Fed might need to move more aggressively. But at the moment, quite a few pockets of upside, especially so in the Netherlands, Germany, and in Spain and France. The CAC's up about 0.5 of 1%, leading the gains on the continent. I want to check in on a particular mover in the last few minutes, and that is Rémy Cointreau. We are seeing quite a bit of upside here. The news being that they're forecasting solid sales growth this year after the pandemic taught consumers to mix more cocktails at home, and as the spirits makers raises prices to offset inflation. The earnings rose 40% in the year intraday at the moment. We're coming off just a little bit, about 0.9 of 1%. We'll see what direction it finally lands on in the next hour or two. But again, first quarter sales should be strong despite a difficult comparison to last year and lockdowns in China, which is one of its biggest markets. Betting on a potentially resilient consumer. Rémy Cointreau just above 170 euros a share. Let's get out to Giulio Renzi-Ricci. He's the head of asset allocation for Europe at Vanguard. So Giulio, maybe we can take some of the learnings from Rémy Cointreau, not so much, having a good time, but more about what it tells us about the consumer, potential resilience in Europe?
Yes, absolutely. I mean, it comes down to inflation. It is one of the main topics, of course, for any type of investors at the moment. There are some aspects that can be considered. So one thing at a portfolio level is that we always advocated to consider inflation and hedging inflation at the beta level. And what I mean by that is considering the total portfolio sensitivity towards inflation. There are, of course, certain asset classes, sub-asset classes that have a very high inflation beta, and that means that with only a fraction of allocation towards those assets, you can hedge your portfolio more completely at an holistic level towards total level of inflation. The assets that I'm talking about here are mostly commodities. They tend to have inflation betas that are much higher than other asset classes. Compared also to TIPS and REITs, which work well in order to hedge inflations, but have a high level of correlation with inflation, but lower inflation beta. So you need a lot of them in order to hedge your entire portfolio.
I mean, that makes a lot of sense to a lot of people, that you would hedge with a beta in excess of 1, right? So you add a little bit of gold or whatever to your portfolio. But like, what percentage are we talking about here specifically, roughly, on average?
Well, of course, that is a very difficult question to answer for any type of investors. It depends on many factors. It depends on what the objectives are, if inflation hedging is one of the key objectives, or if there are other objectives that play a role, of course, here in terms of a return target or maybe volatility targeting and the level of risk aversion. So it's quite hard to give a general rule of the thumb. But those have to be taken into account also given the other asset classes that might play a role in the asset allocation and in the portfolio of any given investors. What we can say, I think, around inflation hedging at the moment, in this specific level, is maybe a discussion around value versus growth. Value stocks have been performing quite poorly over the past 7 to 8 years, especially compared to growth stock. We're talking about an average the return difference of 7%. Our views on values now are much better, and that the main reason for that is actually inflation hedging. What it means is that with higher rates, the discount rates also are higher, and the later cash flows that growth stocks tend to have get penalized and discounted much more heavily than value stocks.
Just to jump in here with some lines coming through from François Villeroy de Gallo, the governor of the Banque de France. He is saying that the normalization of ECB policy is required. ECB normalization is not tightening. European growth will be slower in the next 2 years. And he also adds that European fiscal policy is constrained by COVID debts. Give me a sense of what your thinking is around what the ECB needs to do over the next 30 days in terms of communication, in terms of signaling, to make sure that it remains insulated to a Fed that wants to front load.
Of course, I think that the ECB, as we mentioned earlier, is behind the curve compared to the Fed, and they're learning a lot from the actions and potentially some of the mistakes that have been made by the Fed. There is a reasons to be a little bit more concerned about recession risk in the European areas. The numbers that are coming out for Europe are not as good as the numbers that are coming out for the US. So, of course, the central bank has a very difficult task at the moment and is balancing that inflation risk, in managing expectations on inflation with the risk of entering into a recession. So that is something that is shifting, and to be honest, this is something that is changing on a daily basis where they might lead. The current consensus within the ECB is now that they might be a little bit more hawkish over the very short term in order to dissipate any fears of rising inflation.
Giulio, it's been a fantastic conversation. Thank you for making the time and running us through some of the insights. That's Giulio Renzi-Ricci. He's the head of asset allocation for Europe at Vanguard. Now to another major story from the corporate world. Sheryl Sandberg is stepping down as Chief Operating Officer of Meta after nearly a decade and a half as Mark Zuckerberg's second in command. Bloomberg's Ed Ludlow has more from San Francisco.
Over 14 years, Sheryl Sandberg has taken the company formerly known as Facebook, now known as Meta Platforms, from a fledgling startup and social network to an advertising behemoth that brought in $120 billion of sales last year. Sandberg's going to stay on Meta's board, but the writing's been on the wall for some time. A lot of folks have asked the question, will Sandberg stay? There was a report in July of 2021 of a rift between Mark Zuckerberg, the company's founder and CEO. In a conversation with Bloomberg, Sandberg gave her reasons on why now is the time for her to leave the company.
The decision I didn't come to lightly, but it's been 14 years. It's been 14 years, and I want to make more room to do more philanthropically, to do more with my foundation. I've definitely not been able to do nearly as much as I have wanted to recently. It's a really important moment for women.
When Sandberg joined Facebook in 2008, it was just a fraction of its global user base that it has now. Mark Zuckerberg was a college dropout with very little experience, and Sandberg's played a very central role on Meta and Facebook, growing to a multi-platform company that has more than 1 billion users in more than one of its platforms. But her replacement is also capable. Javier Olivan has been focused on the company's growth initiatives for some time now. He's a former VP of product working on all of the platforms, not just the core Facebook product. But it was interesting to see the stock fall so sharply when the headlines of Sandberg's departure crossed the Bloomberg, investors identifying perhaps some key man or key woman risk in that announcement. And Facebook's also in a transition, or Meta is also in a transition from being an ad-based model where it relies on users being targeted with ads on its platform to a future in the metaverse where it wants to sell more hardware and have users spending on services that are linked to experiences in the metaverse, experienced through virtual and augmented reality. Ed Ludlow for Bloomberg News in San Francisco.
And from Meta, let's get to some of the other business flash stories we're watching with Laura Wright. Laura.
Thanks, Yusuf. Pfizer has asked US regulators to approve its COVID vaccine for emergency use in children under age 5. Last month, Pfizer and its partner BioNTech announced in late May that a 3-shot regimen was highly effective in children. Their trial is likely to pave the way for infants and toddlers to get immunized. Lawyers for Goldman Sachs have asked a New York federal judge to suppress the names of 2 senior executives in one of Wall Street's biggest gender discrimination lawsuits. Women suing the bank have asked for disclosure of filings naming, quote, high-ranking alleged sexual harassers. Goldman says the executives are not defendants in the class action, and such a disclosure would sensationalize the case. Elon Musk has given an ultimatum to Tesla employees, saying everybody at the company has to return to the office. The Tesla CEO sent an email to executive staff with the subject line, "Remote work is no longer acceptable." He wrote that anyone who wishes to do remote work must be in the office for a minimum of 40 hours per week or leave Tesla. That's the Bloomberg Business Flash. Danny. Oh, Yusuf. I apologize, Yusuf.
I thought there for a second. That's not me. Yes, thank you very much, Laura, right there in London. Let's get you a bit of a preview of what else is to come. Crude slides on a report that Saudi Arabia could replace lost Russian oil output. More on OPEC Plus today. That's next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the European Market Open. Let's focus in on some of the movements in the energy spectrum because crude prices dropped following an FT report. Saudi Arabia is ready to pump more should Russian output decline due to increasing sanctions. The group, which meets today, is expected to ratify a modest increase in output for July. Let's get more on this with our Bloomberg energy reporter, Steven Stupczynski. So, Steven, what would drive the Saudis then to do this, given their animosity towards the U.S. Earlier on in U.S. President Joe Biden's administration?
You know, it's all about Russia right now. There were other reports from the Wall Street Journal saying that Russia might be exempt from the OPEC Plus deal. Russia, because there's going to be a European Union is looking to ban, the Russian crude imports, at least seaborne crude imports. That is going to affect the country. And there's an expectation that Russian crude production is going to fall this year, potentially by 8%. That's going to be a hole that Saudi Arabia and the UAE would be willing to fill, according to the FT. Now, we haven't confirmed that, and the talks are in very early stages, but it could be brought up as early as today at the OPEC Plus meeting. That's why everything is a bit tenser today. We were expecting a rubber stamp, just adding 400,000 barrels to the market next month over their planned increase through September, but they might bring some more of that supply that was supposed to come online in September up to August or potentially July, which could make today's meeting quite bearish for the market if they do agree to a larger than normal increase in production.
Steven, we're going to leave it there. Thank you very much for getting straight to the point and giving us the gist of the OPEC Plus meeting in terms of expectations. Because in the past, we've often had big surprises. Steven Stupczynski there with the details. Let's get you a bit of a preview then of what's coming up, our exclusive conversation with the Bank of Israel Governor Amir Yaron. That's next, looking here at equities in Europe, still holding on to upside following the negative feed-through, pockets of momentum in positive territory, especially so in equities on the French exchange in France, on the CAC 40 specifically. That's ahead. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently because various studies showing that reduction up to 40-fold, meaning that a third dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Welcome back to the Open. We are 30 minutes into the European trading day. Here are the top stories we're watching. Jamie Dimon's hurricane warning. The JP Morgan CEO warns investors of an unprecedented combination of challenges to the U.S. economy. Coming off the boil, oil prices drop after a report Saudi Arabia may boost production. OPEC Plus meets in the next few hours. And Israel kicks off its first hiking cycle in over a decade. Don't miss our exclusive conversation with the Bank of Israel Governor Amir Yaron. That's happening very shortly. I want to get to some of the stock action in the European side of things, because overnight, yes, it was a negative handover, but we're holding on to modest gains as it stands on the Eurostock 600, up about 0.2%. Looking here at the construction and consumer shares that are leading the gains. Energy stocks, and I talked about this a bit at the top of the show, they are indeed the laggards. The UK markets are shut for holidays to mark Queen Elizabeth II's Platinum Jubilee. We're a bit higher on the S&P 500 mini contracts, though, specifically. So it looks like those gains are going to be handed over later in the day. We'll see how that evolves. Let's get to Israel now, because the country embarked on its first cycle of interest rate hikes in more than a decade in May. It raised borrowing costs more than forecast in response to above target inflation, and also data showing an uptick in wage increases. The increases to 0.75% from 0.35%, to give you the full picture, exceeded the estimates of most analysts surveyed by Bloomberg. We're now joined by the Bank of Israel Governor Amir Yaron. Governor, let's get straight to the inflation forecasts. Do you expect them to peak soon, or could there be quite a bit of more pain to come?
First of all, good morning, Yusuf and the audience. Our inflation is at 4% currently, and the Bank of Israel and most forecasters see it hovering around 4%, probably a little bit above 4% for the next couple of months, and then start declining, and towards Q1 23, entering back into the target, the upper part of the target range, which is 3%. We at the Bank of Israel are committed, determined to bring it back into the target.
In terms of the source of cost pressures, as much as commodities is a big component of that globally, you also have business wages, which is something you referenced in your statement a couple of weeks ago. What can be done to address that?
So obviously, energy prices are affecting everyone around the world. That is also true in Israel, but we have less of an exposure to the high prices of energy because of our natural gas and the long-dated contracts that the government has put in. But obviously, it's also affecting our economy. We are seeing wage pressures in the high-tech sector, but we're not seeing it as much in the other sectors, and we will have to monitor what kind of wage agreement are going to be signed as we go on into 2023. And obviously, those can impact, we all understand the issue of wage and price cycle. Having said that, as I mentioned, the Bank of Israel is committed to bringing inflation back to the target, and we probably have an easier time. We may have easier time than others because our inflation is significantly lower than pretty much all other OECD countries.
I mean, I was going to follow up on that because that is the big debate, isn't it, in monetary policy today, is how do you bring down inflation without derailing growth? How convinced are you that in Israel you can pull that off?
So our estimate for growth is 5.5% for 2022 and about 4% in 2023. Obviously, in the background, there's the looming, and obviously there are horrific, notwithstanding the horrific issues that are going on in Ukraine and Russia, we have very little direct exposure in terms of our exports to that area. The zero COVID policy in China, all those are impacting both upticking pressures towards it, for inflation, as well as impacting slowdown in the global economy. And that balance obviously will impact where rates are going in terms of our intensity of the process for addressing inflation. And I think you already are seeing some estimates for basically 1% impact in Europe, maybe a third to a 0.5% impact in the US. And for us, that is already internalized in these growth rates that I've mentioned. But one has to recognize there is huge uncertainty right now around these estimates. And the process for rates will have to balance out this impact on slowdown on the one hand, and on the other hand, how inflation proceeds.
Governor, you announced that you intend to diversify the bank's foreign exchange reserves. You've added yuan into the mix. I'm wondering what the mix looks like today, and what are you investing in?
Well, we have, as we have a larger reserve pool right now, around $200 billion, we are looking at a more diversified set of instruments and currencies. One of them you mentioned included the yuan, but we have a broader set of currencies, and we're also going into a broader set of instruments, including equities, high yield corporate bonds, and it's part of our way of enhancing the overall return on these reserves as we're looking at medium run outlook for the return on our investments.
We heard from Jamie Dimon on Bloomberg Television earlier. He was talking about a hurricane that's approaching the U.S. economy. We heard similar statements from some of his peers, but he doesn't come out and say that very often. I'm wondering whether you're making any additional preparations for a new wave of painful volatility that's going to rip through the global economy.
I think everybody's speaking about whether it'll be a soft landing or a hard landing. He used the term you've mentioned. I think it's very hard to really know exactly how it'll work its way out. And part of it I've already talked about, this balance between slowdown on the one hand, inflation on the other, and perhaps both of them coming in together. And obviously, for us, the high-tech sector is immensely important. We are seeing some corrections that have already happened in NASDAQ. We know that has an impact on our high-tech sector. Having said that, we think our high-tech sector is much more mature than in 10, 20 years ago. It is more diversified. It has more exposure to funding, both internal and external. And so I think it has more stomach, it's more formidable in terms of addressing shocks. But obviously, it depends the intensity and, very importantly, how duration, if we have a slowdown, how long that will last. And I think this is something we are very closely monitoring at the Bank of Israel.
Governor, thank you very much for making the time and getting us the lowdown on what the thinking is in the Bank of Israel. That's Amir Yaron. He's the governor, of course, of the Bank of Israel. Still to come on the show, European Commission Executive Vice President Valdis Dombrovskis tells Bloomberg that the latest EU sanctions strike at the heart of Putin's war machine. We have that exclusive interview next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that. Bloomberg Television. Top experts. Great questions.
Welcome back to the Open. We are 41 minutes into the European trading day. This is the state of play, the Stocks Europe 600. Just building a little bit of more upside momentum here, up about 0.2%. We are seeing the energy component being the laggard with Brent and WTI under pressure. That was largely expected. It also has been the best performing sector within the Stocks 600 so far this year. And the gains being led by stocks in France, up 0.9% of the benchmark CAC 40. Let's get to the first word news now as well to kind of round out the picture for you. And Laura Wright joins us for that. Laura.
Thanks, Yusuf. Bloomberg's been told that EU efforts to approve a partial ban on Russian oil imports have hit an obstacle, with Hungary raising new or already rejected demands. That's further delayed a push to clinch a deal. Our sources say EU ambassadors may meet again on Thursday in Luxembourg to try to greenlight the bloc's 6th sanctions package against Moscow. Russia has been judged to have breached the terms on a bond after missing a $1.9 million interest payment. The failure triggered an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said the event occurred on credit default swaps because Russia did not include the additional interest in a late bond payment made at the start of last month. The Eurozone is moving closer to adding its 20th member. Croatia has been ruled to be suitable to join the club next year. The European Commission recommended that the country should be allowed to adopt the common currency after finding that it fulfills the necessary requirements on issues including inflation and public debt. Banks in China are facing growing pressure to support cash-strapped property developers. Regulators have been pleading for months, but that hasn't boosted lending to the industry. Builders and regulators are counting on banks to provide a lifeline as bond funding and home sales dry up. Bank of England Deputy Governor John Cunliffe says the UK housing market is starting to slow. Speaking on ITV News, Cunliffe said property prices will be dragged down by rising interest rates and easing economic growth. The remarks followed a 10th consecutive monthly rise in house prices, even as living standards are squeezed. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Yusuf.
Thank you very much, Laura, right there. Now, the European Commission Executive Vice President Valdis Dombrovskis has told Bloomberg that nothing is off the table when it comes to hitting Russia's economy. That includes possible future sanctions on Russian gas. In an exclusive interview with Maria Tadeo, he said that the latest EU sanctions package strikes at the heart of Putin's war machine.
We need to continue to support Ukraine, including by military support, which is probably the critical one now in a short term, and we need to continue to put pressure against Russia to stop its aggression. And from that point of view, the fact that finally there is agreement on a 6 sanctions package, it's an important fact. And indeed, there are major steps like oil embargo, not fully as European Commission was proposing, but anyway, at the end of the year it will be 90% less imports of Russian oil. Also the fact that we are de-swifting the largest Russian bank, Sberbank, so it's a very substantial package. So we need to continue to do this pressure, so to support Ukraine and to continue pressure against Russia.
And if you implement this package, and if you believe that it will be fully implemented, do you have any internal calculation in terms of the economic damage that this is going to do to Russia? A lot of this is about preventing them from funding the war, to be in a position where they don't have the financial means to continue to push on the battlefield. Do you have any estimates in terms of the actual impact that it could have?
Indeed, if you look at the situation pre-war, 62% of Russia's exports to the EU were fossil fuels. We have already banned coal import in one of the previous sanction packages. Now we are pretty much banning oil imports, so we're really getting to the heart of the financing of Putin's war machine. And also the other measures related to Sberbank, to other Russian banks and other steps we are taking, they are going to have substantial impact on Russia's economy.
And of course you mentioned coal, then it was oil, and the way that the European Union kind of hinted and calibrated this is that the final step would be gas. Are we going to see sanctions on gas, which is seen as the big geopolitical weapon of the Russian Federation?
As we have been saying from the European Commission very consistently, all options are on table. So we are not excluding anything, but it also must be said that regardless of sanctions, the strategic decision to move away from dependency on Russian fossil fuels is already taken, and there is already a plan in place, Repower EU plan, to describe how we'll be doing this, including rapid phase-out also of our dependency of Russian gas supplies.
Your message to Russia is that ultimately this is going to end one way or another. It's the end of Russia as a great energy power, I believe, essentially. This war will trigger that for them. They were a big player in the energy market with the measures taken by the European Union, and as the powers that you also point over the long term, this will be the end of it for Russia.
It is going to be the end of energy relations in this form between Russia and EU. Obviously, the EU is not the only buyer in the world market, so Russia will be seeking alternative markets for its energy, but right now we are seeing that they are actually selling, for example, their oil at some 30-35% discount.
And of course, the market is also paying attention to that and predicting more discounts will happen after the measures that were announced yesterday. So ultimately, it's not a good deal for Russia, even if they turn to India or China. Is that what you basically operate with? Even if they try to buy new or find new buyers, this is not a good financial deal. You're going to lose money either way.
Exactly, and of course, Russia is making lots of emphasis to increasing supplies to China. But what we are seeing, and especially in this situation of Russia's weaknesses vis-a-vis China, China is going to take a good advantage of this, and it's not going to be very advantageous deals for Russia.
European Trade Commissioner Valdis Dombrovskis speaking exclusively with Bloomberg's Maria Tadeo. You've got European bonds posting losses, but what's standing out to me is the Swissy. Wow. I mean, the inflation numbers came through in the last hour, and it came in much harder than anticipated. The market had been looking for a print of 0.7% month on month. Sorry, what came through was 0.7%. What was estimated was 0.3%. That's more than double the estimate in May. And as a result, we're seeing a big move in Euro Swissy and in Dollar Swissy as now expectations turn to the SNB for a potential move to try and bring that back under control. A one-month high for the Swiss franc. Let's get you a bit of a snapshot then of what else is coming up on the program. Millions across the UK and the Commonwealth prepared to mark 70 years since Queen Elizabeth II accessed the throne. We take a look at some of the possible economic pitfalls and positives of the Platinum Jubilee. That's next. This is Bloomberg.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open. We are 52 minutes into the European trading day. This is the upside that we're seeing, and momentum is still very firm, especially so in French stocks, with the CAC 40 up about 0.8%. It is a bank holiday in the UK, so FTSE 100 contracts are offline, lighter liquidity. So, of course, the representative nature of some of these indexes is a little bit less than usual. But let's stay with UK markets because, as I mentioned, they're offline for the Queen's Jubilee celebrations, marking 70 years on the throne. Bloomberg's Laura Wright has been investigating the projected economic boost and the pullback of the long weekend. So, Laura, let's talk about the expected short-term economic bounce. How much is there to it?
Well, Yusuf, forward-looking data tells us that the UK is taking a go big or go home approach this bank holiday weekend, whether it's stocking up on victorious sponge cakes, preparing for street parties. Springboard data shows us that retail footfall for this week is expected to be 8% higher than last week, and for the same period, UK high streets are predicted to be the biggest gainer, followed by shopping centres and retail parks. UK hospitality is forecast to bring in £2 billion over the long weekend. To put that in context, that's almost £400 million higher than a typical Thursday to Sunday at this time of year. What is really interesting is the travel sector. Cirium data reveals that UK flight departures are up over 200% year over year from June the 2nd until June the 5th, and over 1,000% compared to the same period 2 years ago. Passengers taking advantage of that long weekend to travel abroad. What all this shows us, Yusuf, revenge spending for the Jubilee celebrations have arrived.
I mean, yeah, so those are the good times. You're working today, so that means you're going to be able to take that extra day at a later stage. What are the broader implications of the bank holiday for the economy?
Yes, sadly, there are repercussions. As much as we would love this to be an annual holiday fixture, if we use historical examples of when an extra bank holiday has been added to the month of June because of previous Jubilee celebrations, such as in 2002 and in 2012, typically for that month, the UK economy contracts by around 2%. Now, the dotted line for both situations shows us how GDP would have behaved without an extended holiday. Using this analysis, quarterly GDP falls around 0.5%, and that means for the second quarter of 2022, GDP is expected to be in contraction territory, and actually that aligns with the Bank of England's view. Usually there is a rebound after such an event, but this time around, Yusuf, the path is more challenging because of the macroeconomic climate, cost of living crisis, and consumer confidence at dire levels. But Yusuf, I've been doing some thinking. To put this issue to rest, perhaps we should have a referendum about whether this does become an annual event.
Well, I mean, I wouldn't feel bad about it because much of the rest of the world has a lot more holidays than the UK. Egypt apparently has some of the most holidays. They've got something for everything, even more creative than the bank holiday in the UK. The Jubilee. Laura, thank you for that. Bloomberg's Laura Wright. Quick look at some of the bonds in the current session. We're seeing a little bit of downside here in some of the German paper on the 10-year specific, about 1 basis point off here at 122. The steady start, traders watching for clues about how quickly the ECB may tighten monetary policy. That's it for the European market open. I was stepping in from Francine Lacroix. Surveillance Early Edition takes it from here. This is Bloomberg.
Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
We could look at reducing the policy rate in future years, 2020, maybe late 2023 or 2024.
When there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor.
It's a hurricane. That hurricane is right out there down the road coming our way.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine Lacqua. Here's what's coming up on today's program. Hurricane warning. JP Morgan CEO Jamie Dimon warns investors of an unprecedented combination of challenges to the U.S. economy. Off the boil, oil prices drop after reports Saudi Arabia may boost production. OPEC Plus meets today. Plus, metamorphosis. Sheryl Sandberg steps down from Meta after 14 years, having helped transform the social media startup into a multi-billion-dollar powerhouse. Happy Thursday. It is a more than quiet Thursday, given that the UK is off on holiday. You have an HK holiday tomorrow and China, so volumes are light. Here's how the picture is shaping up cross-market. Euro Stock 600 up about 1/3%. Again, UK offline, so volumes I've seen off as much as 15%, so probably any of the bulk of market moves would have been put on yesterday. Your 10-year yield, that continues to move higher, not even by a basis point, but still, it has been a global move of rates higher after yesterday's Bank of Canada decision. Back-to-back 50 basis point hikes, saying that they are able to do more. They will do what it takes to reach their 2% target. Of course, some hawkish noise coming out of the ECB as well. So that is a really global story. Also looking at S&P 500 higher by 0.2%. Now, Brent crude, that was also falling by 2% after these reports that Saudi may step in to make up for the lost amount of oil coming from Russia. Now, from the map, again, a lot of mix here. You see the UK in the red. Just ignore that. That's yesterday's price action. Again, it is closed today and tomorrow. DAX were higher by about 0.5%. CAC 40 were also higher by 0.6%. So perhaps just giving back a little bit of yesterday. Not unusual to see that back and forth. But again, because volumes are late, there is that opportunity for volatility. You especially might see that as we get closer to the U.S. Open, when volumes finally do pick up. Now, JP Morgan CEO Jamie Dimon has warned that the U.S. is about to face an economic hurricane. He was speaking at the annual Strategic Decisions Conference in New York City and drew attention to struggles against fiscally induced growth, quantitative tightening, and Russia's invasion of Ukraine.
It's a hurricane. Right now, it's kind of sunny. Things are doing fine. You know, everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy, or Sandy or Andrew or something like that. And it's you better brace yourself.
But for some at Diamond's firm, the calm before the storm may also provide an opportunity, or it's already priced in. Strategist Marko Kolanovic wrote in a note to clients yesterday, "We remain positive on risky assets due to record low positioning, bearish sentiment, and our view that there will be no recession given supports from U.S. consumers, global post-COVID reopening, and China stimulus recovery." Of course, he's been bullish for most of this year. Now, we've also spoke to Oaktree founder Howard Marks. He told us that he sees a better investment environment for bargain hunters.
Attitudes are more balanced today, but when there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. Now the prospective returns on many asset classes are higher than they were just a little while ago, and again, a much better climate for the bargain hunter.
Let's get straight to the markets conversation now with Mark Hayfley, UBS CIO for Global Wealth Management. Mark, it is a very difficult environment for many folks watching this program who are participating in this market. Is this the kind of market that you want to be on the sidelines, or are you like Howard Marks bargain hunting right now?
Well, we are bargain hunting in the sense that we have the same focus on value. And I think, if you put together that great litany of comments, there's a lot of disagreement on many things that are out there. But one thing that's clear to us is that we are going to end this year with inflation above the Fed's target. And what we've found is that when inflation is above 3%, and we expect to end the year above 3%, value stocks outperform growth stocks. And so that's key to how we're thinking about this market right now.
We've heard folks say that, look, growth has sold off to the point where a lot of them are starting to change into value stocks. Mark, is it really that simple that some of these growth names have sold off enough that they are now in your value bucket?
Well, nothing is simple right now, but I would, yeah. I think that where you have quality growth or quality value, where you're starting, and maybe some of these growth stocks are former growth stocks are starting to fall into this category, where you do have strong buyback, strong shareholder value. You can fit them in that bucket. But I think for us, when we screen these things, I think we're leaning more towards stocks, say in the UK market, which are more focused on commodities and energy. It's still more traditional value than a portfolio of former growth stocks.
When we're talking about some of these factors, Mark, value versus growth, that's a traditional one, but one that has historically worked very well is momentum. Now, Kyu-Sung Lee of Carlyle was speaking yesterday saying that the momentum trade is gone. We're back to fundamentals. Do you see something similar, the value trade, the momentum trade rather evaporating in this environment?
Well, it's hard. It depends, I guess, on what your momentum signals are focused on, but it's certainly been a very choppy market, and that's harder for that can be harder for CTA-focused funds or even global macro funds. So we're pleased that kind of the value more on the stock picking approach is working for right now, but that can change as we start to set up what could be something more of a significant shift, because we saw that rise in interest rates, and we saw that tremendous interest rate volatility, which contributed to the fall in stocks. But if that rate vol comes out and people start feeling like the Federal Reserve's hikes have been fully priced in, then we could indeed settle down. And we think that, based on what people have already priced in, we can end the year with the S&P 500 higher from these levels.
Is that your base case?
In our base case, we're looking at something like 4,300 for the S&P at the end of the year. Yeah, I think people have to realize a little bit that there's some kind of a cap on how far equities can maybe go up this year, because if they start doing too well, that's a free fire zone for the Federal Reserve to start talking markets down again.
That is something that Mike Wilson over at Morgan Stanley says. So do you agree with this idea that stocks rallying, that's just going to push the Fed to go harder, faster?
Well, I don't want to say, I can't speak in detail of all of Mike's forecasts, but what I would say is that the more markets go up, the easier it is for the hawks on the Fed to become a little louder. But again, we don't think the market has kind of reached where fair value given the circumstances we see today.
All right, Mark, you're going to stick around with us. Much more to discuss. Mark Haefele, UBS CIO for Global Wealth Management. Coming up, crude slides on a report that Saudi Arabia could replace lost Russian oil. We're going to bring you the latest on the world's most important commodity next. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, with the UK on holiday, volumes are light, off as much as 50% for some of these European markets, but still looking at gains in the Europe Stock 600, about a third of 1%. We'll see if that picks up at all as volume picks up when we get closer to the U.S. Open. Continuing to see U.S. 10-year yields moving higher, bonds selling off ever so slightly, but pushing closer to that 3% yet again, given that global central banks, be it the Bank of Canada, be it continuously from the Fed, and of course the ECB, more hawkish noise coming out of there. Oil, one to keep our eye on. We're going to discuss that in just a bit, but Brent crude moving lower by 2.2%, given that there are noises, or at least speculation, that Saudi might do more to offset the loss of production crude. Let's get to our other top stories around the world with the Bloomberg First Word News is Angel Feliciano. Hi, Angel.
Hi, Danny. Bloomberg's been told that the EU efforts to approve a partial ban on Russian oil imports have hit an obstacle, with Hungary raising new or already rejected demands. That's further delayed a push to clinch a deal. Our sources say EU ambassadors may meet again on Thursday in Luxembourg to try to greenlight the bloc's 6 sanctions package against Moscow. The Eurozone is moving closer to adding its 20th member. Croatia has been ruled to be suitable to join the club next year. The European Commission recommended that the country should be allowed to adopt a common currency after finding that it fulfills the necessary requirements on issues including inflation and public debt. Banks in China are facing growing pressure to support cash-strapped property developers. Regulators have been pleading for months, but that hasn't boosted lending to the industry. Builders and regulators are counting on banks to provide a lifeline as bond funding and home sales dry up. Russia has been judged to have breached the terms on a bond after missing a $1.9 million interest payment. That failure triggered an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said the event occurred on credit default swaps because Russia didn't include the additional interest in a late bond payment made at the start of last month. Bank of England Deputy Governor John Cunliffe says the UK housing market is starting to slow. Speaking on ITV News, Cunliffe said property prices will be dragged down by rising interest rates and easing economic growth. The remarks followed a 10th consecutive monthly rise in house prices, even as living standards get squeezed. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Danny.
Angel, thanks so much. Angel Feliciano there. Let's get the latest on oil markets ahead of today's monthly OPEC Plus meeting. We're watching crude prices dropping. That follows an FT report that Saudi Arabia is ready to pump more should Russian output decline due to increased sanctions. Now, the group, which again meets today, is expected to ratify a modest increase in output for July. Joining us now is our energy reporter in Singapore, Stephen Stupczynski. Stephen, thanks for hanging around for us. So first off, does Saudi and the rest of OPEC actually have the ability to offset the loss of Russian oil?
That's the big question, and I think there are a lot of doubts about that at the moment. For a long time, Saudi Arabia and other countries have struggled to even hit the modest increases every month of 400,000 barrels a day. If suddenly you take out a chunk of Russian supply, they're one of the world's biggest exporters, that's going to be very difficult, and it can't happen overnight. But that is what Saudi Arabia is telling Western allies, according to the FT. They said that they, Saudi Arabia, as well as the UAE, would be able to meet that deficit. This year, we could see Russian exports fall 8% because of oil bans in the U.S. and in Europe. That would cut a lot of the market and a lot of instability. But Saudi Arabia says that they can meet that supply. Don't worry, and that's why markets are falling today.
Stephen, thanks very much. Stephen Stupczynski there with a roundup of the latest on Saudi and oil. Mark Haefele is still with us, UBS CIO Global Wealth Management. Mark, let's put aside for a second of the likelihood of this happening and instead focus on the drop of oil prices. Should this happen, should oil prices start to drop, can you walk me through the ripple effects that would have across assets?
Well, if oil prices were to fall, I think the most important effect there is that inflation expectations might also fall, and that gives maybe people the idea that the Fed has more room to maneuver in the back half of the year, puts views that we're going to move into a recession further out, and it could be very good for markets, and it's certainly good for consumers. But oil prices falling is a big if, and it's really not something that we're counting on.
Right, and then you have the other issue of it not just being an oil supply issue, right? You have China, for example. I mean, if oil were to fall, is that even enough to bring relief to the Fed?
Well, I think you make a good point, because if you look at the oil is such an interesting global picture. And if you look at what's happened with the zero COVID policy and how much growth that's taken out of China, which, China's been the largest source of growth for the global economy. Should China come back online, that is going to be increased energy demand. And so we see commodities and oil and energy stocks as an important part of portfolios here, because first, we think that on the demand side, if the macro picture or the geopolitical picture improves, that can help support oil prices. And then if we have further geopolitical tensions or issues around the war in Ukraine, that can also drive the prices higher. So it's a very important asset right now where we're overweight.
Mark, less than a minute to go, but beyond that, you say you're recommending hedges. If there's one market I'm to look at, again, let's put aside energy for a moment, where you are finding hedges, safety in this market, where are you seeing it? And again, about 30 seconds here, Mark.
Well, I think one sector in equities we would look at is healthcare. They've really been hit hard, but we expect the valuations and the continued demand for things like drugs and the dividends in pharma to be something of a hedge for equity portfolios.
Mark, a great roundup of that trade in just 30 seconds. Apologies, out of time. We're going to have to end it there. Mark Hayfully, UBS, Switzerland, CIO, Global Wealth Management. Thanks so much for joining us. Now, coming up, Sheryl Sandberg is stepping down as Chief Operating Officer of Meta after 14 years as Mark Zuckerberg's second in command. We're going to bring you that story next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Sheryl Sandberg is stepping down as Chief Operating Officer of Meta after 14 years as Mark Zuckerberg's second in command. Ed Ludlow has more from San Francisco.
Over 14 years, Sheryl Sandberg has taken the company formerly known as Facebook, now known as Meta Platforms, from a fledgling startup and social network to an advertising behemoth that brought in $120 billion of sales last year. Sandberg's going to stay on Meta's board, but the writing's been on the wall for some time. A lot of folks have asked the question, will Sandberg stay? There was a report in July of 2021 of a rift between Mark Zuckerberg, the company's founder and CEO. In a conversation with Bloomberg, Sandberg gave her reasons on why now is the time for her to leave the company.
The decision I didn't come to lightly, but it's been 14 years. It's been 14 years, and I want to make more room to do more philanthropically, to do more with my foundation. I've definitely not been able to do nearly as much as I have wanted to recently. It's a really important moment for women.
When Sandberg joined Facebook in 2008, it was just a fraction of its global user base that it has now. Mark Zuckerberg was a college dropout with very little experience, and Sandberg's played a very central role on Meta and Facebook, growing to a multi-platform company that has more than 1 billion users in more than one of its platforms. But her replacement is also capable. Javier Olivan has been focused on the company's growth initiatives for some time now. He's a former VP of product working on all of the platforms, not just the core Facebook products. But it was interesting to see the stock fall so sharply when the headlines of Sandberg's departure crossed the Bloomberg, investors identifying perhaps some key man or key woman risk in that announcement. And Facebook's also in a transition, or Meta is also in a transition from being an ad-based model where it relies on users being targeted with ads on its platform to a future in the metaverse where it wants to sell more hardware and have users spending on services that are linked to experiences in the metaverse, experienced through virtual and augmented reality. Ed Ludlow for Bloomberg News in San Francisco.
And of course, Facebook shares falling about 2.6% after that. Now, when it comes to this market, we did have Swiss inflation coming in at a 2008 high just about an hour ago. From that, we've seen some strengthening in the Swiss franc, be it versus the dollar, slightly versus the euro. And this also comes off the back of euro inflation coming in over 8%, a record there. More talk about ECB coming in hawkish. We, of course, had Villeroy saying that inflation, it's too strong, it is too broad. Holtzman also talking about 50 basis points. Deutsche Bank breaking consensus, also predicting a 50 basis point hike come July or September. Now coming up, preparations underway for the Queen's Jubilee weekend. Some markets are closed here in the UK, but we'll talk about which markets are opened and any volatility we could see with the late volume. That's next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Hurricane warning. JP Morgan CEO Jamie Dimon warns investors of an unprecedented combination of challenges to the U.S. economy. Off the boil, oil prices drop after Saudi Arabia report that they might boost production. OPEC Plus meets today. Plus, metamorphosis. Sheryl Sandberg steps down from Meta after 14 years, having helped transform the social media startup into a multi-billion-dollar powerhouse. Good morning. Happy Thursday to you. It's Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Now, a lot of cross currents, a lot of crosstalk in this market. Among them, JP Morgan CEO Jamie Dimon warning that the U.S. is about to face an economic hurricane. Speaking at the annual Strategic Decisions Conference in New York, Dimon drew attention to struggles against fiscally induced growth, quantitative tightening, and Russia's invasion of Ukraine.
It's a hurricane. Right now it's kind of sunny, things are doing fine. You know, everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself.
But for some, the calm before the storm may also provide an opportunity. Along with Klonovich seeing a opportunity for stocks to end the year flat, Oaktree founder Howard Marks told us that he sees a better investment environment for bargain hunters.
Attitudes are more balanced today, when there's euphoria, when there's optimism, when there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains. Now the prospective returns on many asset classes are higher than they were just a little while ago, and again, a much better climate for the bargain hunter.
Well, joining us is someone now who is very accustomed to value investing and has taken advantage of it. It's Alexandra Morris, investment director at Norwegian fund management firm Skagen. Alexandra, thanks so much for joining us. And I know your strategies have benefited from the rally in value stocks. But as we hear more sentiment that perhaps we're now in an environment where a Fed hawkishness is fully priced in, does value have further to run?
Well, I do believe value has a long way to run, because you have to remember where it came from.
Yeah, well, expand more on that, Alexandra. Where did it come from?
Well, it came from extremely lows. We've had, what have we had? About 12 years of consecutive value stocks underperforming growth stocks. With the discrepancy is an all-time high, and therefore we've just barely started on the run for value stocks.
Where do we stand in terms of sentiment? Because you're right, Alexandra, for so long it had been value doesn't work. Decade after decade, it's gotten beat down. Do you see a change in environment where growth investors, the Tiger Cubs of the world, are going to come more on side with that thinking?
Well, yes, I do. I think we've seen a huge shift over the past, say, 6 months with particularly high valued growth stocks, or especially those who are not earning any money, coming crashing down. and value stocks have done very well.
You point to the stocks, the growth stocks that aren't earning any money. As we look at tech being hurt pretty momentously, does there need to be a change in business models for a lot of these companies to succeed at the moment, where it's no longer growth at any cost, it is producing cash flow for investors?
Yeah, cash is king, and it's always been king. So we've had an era now where we've had a violent rush to the most popular stocks, and of course, the more you buy, the more the price is inflated. And you know, they may be fantastic business models, but you do have to have a mind shift that at some point investors will demand cash flow, hard money.
To that point, Alexandra, Kyu-Sung Lee of Carlyle, the CEO over there, says, look, the momentum trade is dead. It's about investing in fundamentals. Alexandra, is that right? Is the momentum trade dead?
No, I wouldn't put it that harshly, but I would just say that go back to your spreadsheets for cash flow and don't jump on the bandwagon of popular stocks. You know, it has to hurt when you invest. That's when you can find the real bargains.
While we're talking about our spreadsheets, Alexandra, tell me what it would mean if Saudi indeed does put more oil into the market. Let's say we see oil prices and Brent crude drop below $100. What does that input do to your models, to your equity allocations?
I don't think a drop down to $100 would have much impact on the equity models. We've $100.
What would then, Alexandra? What would make a difference? What would make a difference to your allocation? What level would you actually see a difference to what you're allocating to?
Well, now you're asking a difficult question. When you're long-term investors, you don't allocate from this kind of sector to another sector overnight. But I would say that we are in an era now where energy is scarce. And so if for some reason there should be a huge recession, demand dries up, and Saudi turns up on the taps for oil, then we could see the oil price dip severely. Would that matter? I don't think so, because we are in a long trend for energy. So it would come back up again, basically.
All right. Alexandra, thanks so much for joining us. Alexandra Morris there, Investment Director at Skagen. Coming up, cocktail-savvy consumers help Remy Contra post a strong year. We're going to discuss their earnings next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Remy Cointreau's earnings rose 40% in the year through March on an adjusted basis. And the outlook, it's positive for the cognac maker. It sees strong sales growth this year despite concerns over China's ongoing lockdowns. I spoke with Remy Cointreau CEO Eric Valla earlier today.
On the short term, there will be an impact when the country is locked down. It's a very severe lockdown, and you see the restaurants and the clubs closing, which does impact our business. If you look at medium and long term, the demographic prospects are very interesting in China, very interesting particularly for products like ours. And we see beyond cognac a growing interest on top of that on whiskies, which I think is a very good news for a group like ours.
Let's bring in our Bloomberg senior consumer staples analyst, Duncan Fox. Duncan, I mean, look, we've had other alcohol companies, Pernod Ricard comes to mind, that have warned about lockdowns in China impacting demand. What do you think makes Remy more confident? We're hearing from Eric there saying, okay, at some point they're going to open and there's going to be more demand. Are they in a different position, or is it just different expectations about what happens to the Chinese economy?
I think there's a little bit of different expectations there. There's no doubt that Remy have done a lot of job on their inventory in the trade, and I think they've got it down pretty much as low as they can. So as you start to see reordering when the towns, cities, etc. reopen, you'll probably see a nice little bounce back for Remy in terms of sales. So yeah, I think it's just the way they've run the business. They're very, very close to their inventory in each market, so they've done a very, very good job on that.
I have to say the other interesting thing I thought in speaking to Mr. Valla was this idea of they can continue to raise prices. They did back in April. He said that they're not planning on it, but it's something that they could do and that they would be looking at doing. But Duncan, we are in a world where cost of living crises are starting to emerge in the UK and other places. Is there any evidence of price elasticity on consumer goods yet, that's starting to finally hit prices?
It's interesting. I would probably say the Remy business is very much more premium and luxury. So there's certainly no pressure, I think, on luxury pricing at the moment. But certainly in the wider consumer staples area anyway, you may be starting to see a little bit of a shift. So far, we're seeing roughly about 5% pricing for most consumer staple stocks, even up to 10% for some. And there's been a little bit of a volume decline, or slowdown really, rather than decline. But where it's difficult to know is whether that's because, last year food service, pubs and clubs reopened, so there was a massive bounce, versus actually genuinely we, the consumer, starting to cut back. I think on lower priced products or more daily products, you're definitely going to see some pressure as we go through the next couple of quarters because, as Eric Valla said there, further pricing is going to be required, possibly up to about 10% for some of the food companies, given the way cost of goods have gone up in the last sort of 3-4 months. So it's pretty difficult times for these companies.
Given the difficulty doesn't seem to be easing, given that supply chain disruptions have maybe eased but stuck around, have we seen any shift from the just-in-time model to more companies having buffer stocks?
Definitely. I mean, just out of interest, Nestle have added something like 2.6 billion Swiss francs of inventory over the last 2 years. Now, part of that will be deals that they've done, but there's no doubt they have made sure that they've got just-in-case inventory, I suppose, rather than just-in-time. For really key ingredients. So the one that really stands out at the moment, though, is sunflower oil, where obviously Ukraine and Russia was over 60% of production in 2021. So that's a product that is key in nearly all food processing businesses. So if you suddenly can't get it, you need to find something to replace. That's particularly sunflower oil's got no taste, so you've then really got limited options. And so you probably do have to have them. Make sure that you've got stock so that you can take yourself through the harvest. And certainly for a lot of the food companies I cover, I think that is the issue that they've got to wrangle with over the next sort of 6 months or so as we go through the harvest periods.
Duncan, thanks so much. That's Bloomberg's Duncan Fox. Now let's get to your Bloomberg Business Flash. With that is Angel Feliciano. Good morning, Angel.
Danny, Pfizer has asked U.S. regulators to approve its COVID vaccine use for emergency in children under age 5. Last month, Pfizer and its partner BioNTech announced in late May that 3 shots were highly effective in kids. Their trial is likely to pave the way for infants and toddlers to get immunized. Lawyers for Goldman Sachs have asked a New York federal judge to suppress the names of 2 senior executives in one of Wall Street's biggest gender discrimination lawsuits. Women suing the bank have asked for disclosure of filings naming, quote, high-ranking alleged sexual harassers. Goldman says the executives are not defendants in the class action, and such disclosure would sensationalize the case. Several Chinese traders are complaining that they were duped into providing loans against artificially inflated aluminum stockpiles. A similar, though much larger, scandal rocked the market less than a decade ago. People with knowledge of the matter said that at least 3 companies lent a total of more than 500 million yuan against stockpiles of the metal stored in a warehouse in the southern province of Guangdong that turned out to be worth significantly less than that. Elon Musk has given an ultimatum to Tesla employees, saying everybody at the company has to return to the office. The Tesla CEO sent an email to executive staff with the subject line, "Remote work is no longer acceptable." He wrote that anyone who wishes to do remote work must be in the office for a minimum of 40 hours per week or leave Tesla. And that's your Bloomberg Business Flash. Danny.
Angel, thanks so much. Angel Feliciano there. European Trade Commissioner Valdis Dombrovskis has told Bloomberg that nothing is off the table when it comes to hitting Russia's economy. That includes possible future sanctions on Russian gas. In an exclusive interview with Maria Tadeo, he said the latest EU sanctions package strikes at the heart of Putin's war machine.
We need to continue to support Ukraine, including by military support, which is probably the critical one now in a short term, and we need to continue to put pressure against Russia to stop its aggression. And from that point of view, the fact that finally there is agreement on a 6 sanctions package, it's an important fact. And indeed, there are major steps like oil embargo, not fully as European Commission was proposing, but anyway, at the end of the year it will be 90% less imports of Russian oil. Also the fact that we are de-swifting the largest Russian bank, Sberbank, so it's a very substantial package. So we need to continue to do this pressure, so support Ukraine, and to continue pressure against Russia.
And if you implement this package, and if you believe that it will be fully implemented, do you have any internal calculation in terms of the economic damage that this is going to do to Russia? A lot of this is about preventing them from funding the war, to be in a position where they don't have the financial means to continue to push on the battlefield. Do you have any estimates in terms of the actual impact that it could have?
Indeed, if you look at the situation pre-war, 62% of Russia's exports to the EU were fossil fuels. We have already banned coal import in one of the previous sanction packages. Now we are pretty much banning oil imports, so we're really getting to the heart of the financing of Putin's war machine. And also the other measures related to Sberbank, to other Russian banks and other steps we are taking, they are going to have substantial impact on Russia's economy.
And of course you mentioned coal, then it was oil, and the way that the European Union kind of hinted and calibrated this is that the final step would be gas. Are we going to see sanctions on gas, which is seen as the big geopolitical weapon of the Russian Federation?
As we had been saying from the European Commission very consistently, all options are on table. So we are not excluding anything, but it also must be said that regardless of sanctions, the strategic decision to move away from dependency on Russian fossil fuels is already taken, and there is already a plan in place, Repower EU plan, to describe how we'll be doing this, including rapid phase-out also of our dependency of Russian gas supplies.
Your message to Russia is that ultimately this is going to end one way or another. It's the end of Russia as a great energy power, I believe, essentially. This war will trigger that for them. They were a big player in the energy market with the measures taken by the European Union, and as the powers that you also point over the long term, this will be the end of it for Russia.
It is going to be the end of energy relations in this form between Russia and EU. Obviously, the EU is not the only buyer in the world market, so Russia will be seeking alternative markets for its energy, but right now we are seeing that they are actually selling, for example, their oil at some 30-35% discount.
And of course, the market is also paying attention to that and predicting more discounts will happen after the measures that were announced yesterday. So ultimately, it's not a good deal for Russia, even if they turn to India or China. Is that what you basically operate with? Even if they try to buy new or find new buyers, this is not a good financial deal. You're going to lose money either way.
Exactly, and of course, Russia is making lots of emphasis to increasing supplies to China. But what we are seeing, and especially in this situation of Russia's weaknesses vis-a-vis China, China is going to take a good advantage of this, and it's not going to be very advantageous deals for Russia.
European Trade Commissioner Valdis Dombrovskis speaking exclusively with Bloomberg's Maria Tadeo. Coming up, as millions across the UK and Commonwealth prepare to mark 70 years since Queen Elizabeth II ascended to the throne, we're going to take a look at some of the possible economic pitfalls and positives of the Platinum Jubilee. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. It's the Queen's Jubilee bank holiday in the UK today, and many people who don't work in television Can you tell someone in TV wrote this? We'll be looking forward to a few days relaxing at home. But what effects might we see on the country's economy? Laura Wright, who is also suffering with us here, not on holiday, has been investigating. Laura, of course not suffering. You've had the joy of looking through the economic consequences. So tell us, is there any short-term bounce we can expect from the Queen's Jubilee?
Yes, Danny. Well, forward-looking data says a revenge spending bounce is likely across retail, hospitality and the travel sector as we stock up on our Victoria sponge, prepare for street parties, visit friends and family. Springboard data shows us that retail footfall for this week is expected to be 8% higher compared to last week. And for the same period, high streets projected to be the biggest gainer, followed by shopping centres and retail parks as appetite for spending becomes conspicuous. Hospitality is set to bring in £2 billion over the extended holiday. That's according to a survey led by UK Hospitality. To put that in context, it's almost £400 million higher than a typical Thursday to Sunday at this time of year. Pubs can stay open until 1 a.m. It's probably still way past our bedtime, Danny Berger. But what is really interesting is the travel sector, beleaguered by the pandemic, but passengers are showing a real appetite to travel abroad. Flight data from Cirium reveals that UK flight departures from the UK are up over 200% year over year from June the 2nd until June the 5th, and up over 1,000% compared to the same period in 2020. Really, Danny, it's a go big or go home approach this weekend.
Laura, quickly here, I mean, are there any other consequences of just having these extra bank holidays?
There are, unfortunately, as much as we would like this to be an annual fixture. If we use historical examples of when an extra bank holiday was added to the month of June because of Jubilee celebrations, such as in 2002 and in 2012, typically for that month, the UK economy contracted on average 2%. The dotted line for the periods shows us how GDP would have behaved without an extended bank holiday. Using this analysis, such an event knocks quarterly GDP by 0.5%. So for the second quarter of 2022, GDP is set to be in contraction territory, and that aligns with the Bank of England's view. Danny.
Laura, thank you so much. Bloomberg's Laura Wright breaking down all of the data of everyone out there celebrating with a Victoria sponge and a gin and tonic. Well, as we round out the hour, continue to see light trading volume, yields higher, stocks higher as well, as we contemplate a central bank that continues on its path to combating inflation. Surveillance continues in the next hour. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The way you get inflation down is you need more slack in the U.S. labor market. That's not a friendly message from the Fed, but that's what's necessary at this point.
When there's greed, when there's risk tolerance, and so forth, that's a very difficult climate for the value investor to find bargains.
For investors, we haven't, reached that critical mass, and folks are still focused on recession risks.
We are in this kind of bear market environment, yet we haven't seen the recession manifest in the macro data yet.
If the United States is not currently in recession, given these food costs, these energy costs, our falling income, we will be in a recession within the next 6 months.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, June 2nd. Our top stories today. The price of oil falls after a report that Saudi Arabia is ready to pump more crude as OPEC Plus meets today. Meanwhile, President Biden is likely to visit the kingdom later this month. Sheryl Sandberg's complicated legacy. The soon-to-be former COO of Facebook's parents built an advertising giant, but also developed a number of blind spots. We'll have analysis. And two very different views of the U.S. economy from J.P. Morgan. Jamie Dimon warns investors to brace for an economic hurricane, but a top strategist predicts a recovery for U.S. stocks. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, let's face it, attention here in London is elsewhere. It's on celebrating 70 years of this Elizabethan era with the Platinum Jubilee. But there's a lot still to talk about in markets. Oh, thanks. There's a lot to talk about in markets, whether it's hurricanes over the economy or oil, very much at the heart of things today.
Yeah, there definitely is a lot to talk about. And Anna, I'm sorry you have to work through the holiday, but I'm glad you're here to talk about it with us. Let's run through what happened in Asia overnight first, because it was a mostly down day for equities in the region, down about 0.75% for the MSCI Asia Pacific Index overall. Now, the big drag was Hong Kong. That Hang Seng Index was down a full percentage point as Hong Kong reverts back to some of its strictest COVID-0 measures, in that anyone who tests positive, even if it's a mild infection due to a subvariant of Omicron, they now have to go back into centralized quarantine. You cannot quarantine at home. So measures are restricting in Hong Kong specifically, but we know in mainland China, specifically in Shanghai, things are starting to loosen up a bit, and that is actually something that is benefiting commodities like iron ore. Iron ore futures were up a little more than 5% in Singapore overnight. We're back to around $140 as there is more optimism around the demand story, potentially from infrastructure spending to bolster the Chinese economy as well. And then on the demand story, we know that central banks in many parts of the world are trying to rein in demand in order to tame inflation. We saw the Bank of Canada move 50 basis points yesterday. Now traders are ramping up bets that the RBA in Australia also may move a little bit more. Now about 40 basis points of hikes priced in for that meeting next week. You see that reflected in the Australian 2-year yield, which was up about 10 basis points overnight, Matt.
All right, we have yields rising here as well as investors let go of bonds, and maybe they're putting some of that money into risk assets today. You can see that the S&P futures are higher, almost 0.5% higher right now. The 10-year yield at 291.13, so getting closer and closer to 3, although not moving really that much, certainly not compared to what we see in Australia. NYMEX crude coming down after the FT reports that the Saudis could push up, while OPEC minus could push up production to make up for lost production out of Russia. So right now, NYMEX crude at 112.97, and Bitcoin is up 1% from midnight, but of course it's much lower than it was when we talked about it this time yesterday. It was, I think, 31.6 yesterday. Today it's 29.930, but you know, it's still hovering around that $30,000 level where it's been for the past few weeks. So not a lot of movement there. Nonetheless, we have a green arrow, so maybe that's risk on. Anna, what do you see in European markets?
Yeah, maybe the preceding risk off, something to do with hurricanes, and good data is bad news for risk assets. Let's have a look at European equity markets. Let's pretend London isn't here. Let's pretend the UK isn't here today. That's reflecting yesterday's move, of course. The rest of the continent really reflecting positivity, bouncing back a little from the sell-off we saw yesterday, and that was driven by some of those hurricane comments from Jamie Dimon and some of the better data out of the US, reinforcing that expectation that we could see more hikes coming through from the Federal Reserve. So today we see European stocks going higher. We see energy is a bit of a laggard. We'll get to the Brent price in a second, but construction stocks actually doing pretty well here in Europe. Saint-Gobain, the French construction business, giving a positive outlook. Here's Brent crude. It is down by 2.2% today, just picking up on what Matt was saying, what Kaylee has referenced, those reports about whether we'll see further pumping from OPEC members, even if they exclude Russia from their calculations. We'll look ahead to that OPEC Plus meeting a little bit later. Rémy Cointreau up by 3.7%. Apparently, this is a spirits maker in France, and apparently all the cocktails we learned to make in lockdown, we're still making them, and that's doing well for Rémy Cointreau right now. We see the Swiss franc actually jumping. This is the dollar down against the Swiss franc, which has actually seen a bit of a boost today. Some inflation data, the highest since 2008, reminding us once again, just like we got a reminder from the Bank of Canada yesterday about that inflation-fighting narrative that is still very much with us in these markets. I put in the pound here because it is the Platinum Jubilee, up by 0.4%, has nothing to do with that, of course. The pound was weaker yesterday on that risk-off move into the dollar. Today we see some of that reverse, Kaylee.
All right, Anna, well, that Platinum Jubilee, obviously one of the big events that is happening in the day ahead, the UK kicking off what is actually a 4-day bank holiday weekend to celebrate Queen Elizabeth II's Platinum Jubilee, 70 years on the throne for the 96-year-old monarch. Also happening today, OPEC Plus will be meeting via video conference at 8:30 a.m. New York time, a very interesting meeting in light of the reports we got overnight on Saudi Arabia. Then Cleveland Fed President Loretta Mester will be discussing the economic outlook at a virtual event at 1 p.m. New York time. And finally, we'll also be getting some U.S. economic data, including initial jobless claims and factory orders, Matt.
All right, so a lot of data coming out that we still need to pay attention to this week. Crude prices front and center following a report from the Financial Times that Saudi Arabia is ready to pump more should Russian output decline due to increasing sanctions. Paul Wallace, who leads our Middle East energy and commodities coverage, joins us now from Dubai. So, Paul, what do we know about OPEC's decision, especially with Russia maybe not participating as much in the meeting?
Hi, Matt. Well, a few days ago, it was looking as if this OPEC Plus meeting today would be pretty boring, and it would be just a rubber stamp exercise for the group to carry on with its previous monthly plans of gradual output increases. But something has shifted in the last few days. Essentially, what it looks like is that the strained relationship between Saudi Arabia, the world's biggest oil exporter, and the U.S. Is improving, or there's been progress made toward getting a rapprochement of sorts between the two countries. The FT is reporting that the Saudi Arabians have told some of their Western allies that they are at least willing to help fill any void from Russia if its crude exports dip significantly. And Bloomberg is also reporting that President Joe Biden's mooted trip to Saudi Arabia is likely to happen this month. So everything suggests that, as I said, there has been a change, and if things between the Saudis and the Americans are on a better footing, that could pave the way for more oil from Saudi Arabia and perhaps some other OPEC members like the UAE.
Okay, Paul, thanks very much. We will look for developments there. Paul Wallace reporting from Dubai. As Paul just mentioned there, President Biden is likely to visit Saudi Arabia later this month as record high gasoline prices weigh on the Democratic Party's political prospects ahead of midterms. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. We were just hearing about that rapprochement of sorts between Saudi Arabia and the U.S. Give us the Washington perspective.
Yeah, well, first, it's news just that he's expected to visit because, one, it would stand to reason if President Biden is visiting Saudi Arabia that he would likely visit with Crown Prince Mohammed bin Salman. That's not something the White House has confirmed, but that is, I think, a fair expectation, which would run counter to what the president had said in the past, that he would only deal with King Salman bin Abdulaziz. Any kind of further communication or easing of the tensions between President Biden and the Crown Prince would be a positive thing for relations between the two countries, or at least from the Crown Prince's perspective. Obviously, the tension is still there over the killing of Jamal Khashoggi, but it does seem to imply a sense of urgency around gas prices and communications with oil-producing countries on the part of President Biden, and maybe a bit of pressure on him on that topic.
Okay, Jack, well, let's turn our focus inward and focus on a domestic issue. I woke up this morning to news of another mass shooting. 4 people killed in a mass shooting in Tulsa, Oklahoma, just 8 days after 21 people, 19 of them were children, were killed in Uvalde, Texas, 18 days after 10 people were killed in a mass shooting in Buffalo, New York. We find ourselves here again, Jack. So I ask the question again, what is the likelihood that Congress is going to do anything about it?
The likelihood is stronger than you might think, given the long-standing inaction and the sort of sense of nothingness legislatively following, Sandy Hook, which was 10 years ago. There are bipartisan meetings. It's been virtual meetings with the Senate out this last week, but conversations led by Chris Murphy from Connecticut and John Cornyn from Texas on the Republican side about what they could do that would be very limited to try to have some sort of bill that responds to the Uvalde shooting. Now, obviously, this keeps the pressure on them. I would point out one of the topics they're discussing that seems to be some low-hanging fruit would be incentivizing state-level red flag laws, where if there's some reason a judge would feel the need to take away someone's guns, that would allow them to do that. Oklahoma is the one state in the country that has an anti-red flag law that would prohibit a state law or county or city level red flag laws. So if there is a push in Congress to incentivize those state laws, Oklahoma, which is in the news because of this shooting, would potentially be one of the main holdouts against that.
Right, but anything they will do is going to be limited and low-hanging fruit rather than, meaningful and comprehensive legislation to address the killing of children, which is, well, that says something about, I think, the state of the country right now. Jack Fitzpatrick of Bloomberg Government in Washington. Sheryl Sandberg is stepping down as Meta's chief operating officer. She became one of the most recognized figures in global business after helping Facebook transform from a startup into a multi-billion-dollar advertising powerhouse. She spoke exclusively to us yesterday.
The decision I didn't come to lightly, but it's been 14 years. It's been 14 years, and I want to make more room to do more philanthropically, to do more with my foundation. I've definitely not been able to do nearly as much as I have wanted to recently. It's a really important moment for women. Emily, I know you and I have spent a lot of time talking about that over the years, but it really feels like a very, very important moment when I think more focus there would really be important to me personally.
Sheryl Sandberg speaking with Bloomberg Technology's Emily Chang there yesterday as that news broke. Let's get over to Danny Berger in London for more on this. Really it's an historic move, certainly for women in business, and has to be one of the most well-known companies in in the history of the world.
Yeah, absolutely. I mean, there are so many superlatives that we could choose from to kind of say, look, this is a big deal. And, you know, you can see it in yesterday's stock price. You hear it in Sheryl Sandberg talking herself, saying, look, it's been 14 years. She did come in, she did transform this company. She'll be staying on the board. But in terms of why she's leaving, she basically just talked about these philanthropic efforts she wanted to pursue. But two people who worked with Sheryl did tell Bloomberg that some of the baggage at Facebook made it harder to work on some of these issues she cares about, like women empowerment and other things as well. So perhaps that has to do with stepping down. But look, share prices fell yesterday immediately after the announcement. They ended the day about 2.6% lower. So this kind of goes to the key woman risk of Sheryl Sandberg leaving. Recall, she came in after transforming Google into an ad behemoth. She comes into Facebook, she helps do the same thing, and now Facebook is in this transition where they're kind of shifting away from that ad-based revenue model. Of course, that's where the revenue is still coming from, but this focus on metaverse, of course, I've been calling them Facebook, they're now Meta. This focus on that and perhaps shifting to sales there in the metaverse has become the new focus, and perhaps that's gotten a finer point put on it now that Sheryl Sandberg is out, Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. Meta shares rebounding slightly in pre-market trading, up about 0.8% this morning. And as for some other stocks on the move in the pre-market, one big one to the upside is Chewy, of course, the online pet supply retailer. It reported after the bell sales topping estimates. One analyst over at Jefferies saying that this shows the recent sell-off in the stock is overdone. Now we're seeing an outsized move higher in early hours, up about 17%. Apparently, a lot of us, I would include myself in that, still spending a lot of money on their pets for things like dog toys. So many dog toys in my apartment. Another stock that is moving higher is GameStop. It too reported after the bell yesterday. A bit mixed. You had a wider loss than expected, but sales actually topped expectations. We're still awaiting more clarity on just how the NFT marketplace that GameStop is launching is going to work out. But that stock is up about 0.75% before the bell. One moving lower on the back of earnings, though, is Hewlett-Packard Enterprise. It cut its profit outlook for the year, blaming a myriad of factors, including currency headwinds, the war in Ukraine, ongoing supply chain issues, stories that we have heard from many, many companies, but that one is weighing on this stock in particular, down about 6% before the bell, Anna.
Pets and cocktails, two lockdown habits, Kaylee, that look as if they are here to stay. Coming up on this program, it's Diamond versus Kalanovic. JP Morgan's top strategist maintains his optimistic forecast, while his boss warns investors to brace for an economic hurricane. We will take a look at those conflicting views shortly. And on the shake-up at Meta, David Kirkpatrick joins us, Techonomy founder and author of The Facebook Effect. Great to get his perspective on this big change at the top at Meta, plus 70 years on the throne. We'll dive into the economics of the Queen's Jubilee celebrations. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
It's a hurricane. Right now it's kind of sunny, things are doing fine. You know, everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself.
JP Morgan CEO Jamie Dimon with a warning yesterday. We saw a different view, though, coming from JP Morgan's chief global market strategist, Marko Kolanovic, who says, quote, there will be no recession given support from U.S. consumers, global post-COVID reopening, and China stimulus and recovery. So what are we to think? Joining us now is Tatiana Dari of Bloomberg Markets Live, fresh in New York, newly arrived. We brought her in out of London. So obviously, it takes two sides to make a market, and here we have them both inside JP Morgan.
Exactly, and that's quite the contrast from Dimon himself. Just 2 weeks ago, he said the economy is very strong. He said credit has never been so good, and we see here his chief market strategist taking an opposing view and saying that markets will rebound here into year end. But just looking at what other voices on Wall Street are saying, I can tell you that there is a growing consensus on Wall Street taking actually the Dimon view and being more bearish, saying that stocks will probably have to fall, earnings estimates will probably have to come down, and there's a lot of economic risks out there and also inflation risks.
Well, and of course, there's been economic risks for some time, yet you also had the support of monetary and fiscal stimulus. Fiscal stimulus checks in the pockets of retail traders who were always willing to come in and buy the dips in this market. Is that behavior now changing as the macroeconomic picture is changing too?
Well, we've seen retail traders being really active in this latest rally and really being empowered and keeping their participation even while stocks fell here in the this month, early this month. So what's interesting about their participation now is they're using a lot more leverage to do that. So, and then market watchers are saying this could get a little dangerous if we get any more episodes of risk aversion. It could really hurt retail traders. And let's not forget that they're also sitting on big year-to-date losses. I think a basket of Goldman Sachs retail favorite stocks is showing they're still sitting on about like a 25% loss. So they've gained, they've certainly gotten a win with the latest market rally, but there's still a long ways to go to recovery.
Some worrying signs there, maybe for retail investors. Tatiana, thank you very much. Tatiana Daria from the Bloomberg Markets Live team. And for more market analysis, check out MLIV Go. That is the function to use on your terminal to keep across the thoughts of Tatiana and the rest of the Markets Live team on their blog. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Banks in China are facing growing pressure to support cash-strapped property developers. Regulators have been pleading for months, but that hasn't boosted lending to the industry. Builders and regulators alike are counting on banks to provide a lifeline as bond funding and home sales dry up. Russia was judged to have breached the terms on a bond after missing a $1.9 million interest payment, and that triggered an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said a failure to pay event occurred on credit default swaps. Still, the failure to pay won't trigger a wider default on Russia's bonds. The U.S. Supreme Court is facing a historic case backlog. The court is due to issue 33 opinions, 53% of its expected total, in the final month of its current term. That's the most in percentage terms in more than 70 years. Among those are rulings that could effectively outlaw abortions in 24 states and put more handguns on the street. And in Virginia, a jury sided with actor Johnny Depp in his libel lawsuit against ex-wife Amber Heard. Jurors awarded him $10 million and vindicated his allegations that Heard lied about Depp abusing her. But the jury also found that Heard was defamed by one of Depp's lawyers and awarded her $2 million. Depp says the jury gave him his life back. Heard says she's heartbroken. And from drama with celebrities, Anna, we turn back to drama in these markets.
Yeah, coming up, Matt Maley joins us, Chief Market Strategist at Miller Tabak. Certainly worth tuning in for after that trial is over. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The price of oil falls after a report that Saudi Arabia is ready to pump more crude as OPEC Plus meets today. Meanwhile, President Biden is likely to visit the kingdom later this month. Soaring gasoline prices are hurting the Democrats' chances in midterm elections. Sheryl Sandberg's complicated legacy, the soon-to-be former COO of Facebook's parent, built an advertising giant. But Sandberg also was criticized for the company's failure to rein in large-scale misinformation, hate speech, and privacy breaches. And two very different views of the U.S. economy from J.P. Morgan. Jamie Dimon warns investors to brace for an economic hurricane. He says the only question is whether it's a big or a small one. At the same time, a top J.P. Morgan strategist predicts a recovery for U.S. stocks. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. So two different views from within J.P. Morgan really illustrates a lack of direction, perhaps, for these markets at this point, Matt.
Yes, although it looks like Kolanovich is the outlier, right? Dimon is the consensus view. The question, though, as Marco points out, is all of this priced in? And clearly investors, at least today, think some of it is. S&P futures are up about 0.5% right now to 4120. We have investors willing to let go at least a little bit of the perceived safety of U.S. government debt, so the yield rising to 291.13 right now. NYMEX crude coming off, as you said, there was the FT report that OPEC could boost production to make up for lost production if sanctions hurt Russia more. So NYMEX crude back down to 112.75. This is remarkable, you know, because 2 days ago we were pushing 120 for Texas Intermediate. So it's $7 shy of that now. And Bitcoin right now up 1.2% from midnight, although it's down from where we saw it 24 hours ago. It was at 31.6, and right now we're looking at 29.983. Kaylee, what do you see in terms of pre-market movers?
Well, I'm focused on that oil story, which of course is oil prices moving lower. And as the underlying commodity moves lower, so too does energy stocks in pre-market trading as a whole. You have Occidental Petroleum, Marathon Oil, each down between 1.5% and 2% or so. And really it's the entire energy complex that you see under pressure. But there are some stocks moving higher as well, including Chewy, the online pet store. It reported results that beat estimates. A lot of people still buying things for their pets. All of those pandemic puppies still getting pampered. It's up 16% in early hours. And then, of course, the story we've talked about a lot already this morning, Sheryl Sandberg stepping down as the COO of Meta Platforms. The question really is, how much key woman risk is there for this company? Investors seem to think there was a great deal yesterday because you saw the stock moving lower immediately after that news crossed, but a little bit of a rebound happening in pre-market trading this morning, Anna. That stock up about 0.8% before the bell.
Yeah, a great story, and one we'll return to shortly, Kaylee, on this programme. Let's check out how European equity markets are doing. We're without London today, of course. London is closed, public holiday today and tomorrow to celebrate 70 years of Queen Elizabeth on the throne. So stocks in Europe depleted in volume, but still there with some positive momentum, up by 0.5% on the Stocks Europe 600. Brent crude echoing what Matt just said about what's going on WTI. Those reports suggesting we might see some change from the Saudi stance when it comes to the amount of oil they're prepared to produce, and Brent crude is down by 2.5% as a result. Remy Cointreau then, in keeping with those lockdown habits that we've clung on to, Kaylee was talking about all those puppies that are still being pampered, cocktails still being made in our homes. Apparently, that's the message from the spirits maker out of France, that is Remy Cointreau, and the stock up by just over 4%. And Daimler Truck Holdings, interesting one here. This is the world's largest truck maker, up by 1.7%. They are seeing some more positive signs when it comes to supply chain issues and the shortage of chips, talking more positively about that in an interview, Kaylee.
All right, Anna, well, let's return to the conversation you and Matt were just having about how Marko Kolanovic of JP Morgan actually is a little bit of an outlier with his rosy outlook. Let's get another take. Matt Maley, Chief Market Strategist at Miller Tabak, is joining us now. So, Matt, clearly Marko is not in consensus here. Consensus says what we're in the middle of right now is just a bear market rally. Is that true, and how much further could it go in that case?
I do think we're in the middle of a bear market rally. Well, the one thing I worry about with that opinion is that so many other people seem to have it. I like to be be one of those outliers that tends to work better. But one thing that is very interesting that I felt that you know what happened in 2000, people kind of forget we had a deep correction in late 2015, early 2016, and one of the things that really was a catalyst for the bounce back, for the bottom of that, was when Jamie Dimon came out and said he personally bought $26 million of JP Morgan stock. I mean, that literally signaled the bottom of that sell-off. The market turned around and rallied, didn't look back for a couple of years. Now, with the market down 15% again, he's saying kind of the opposite. They're quite a bit different. So, you know, Jamie Dimon, going against Jamie Dimon is not something that people really want to do very often, I think.
Okay, Matt, so that's kind of for the economy and the market at large, but in specific pockets of this market, are there areas in which valuations have come in enough damage has been done, that there is now an entry opportunity?
Well, that's kind of hard for people to argue, in my opinion. I just don't think that you know, the markets. I mean, we've worked off the froth that had been created by the Fed's liquidity. You know, it's even questionable at 17 times earnings if that's really fair value. I think it should be closer to 15 times earnings. And plus, we've seen the economy starting to weaken. And you know, GDP forecasts have been cut in half over the last 6 months, and yet earnings forecasts have stayed the same. They, I believe, will start to come down as we move through the second half of the year. That said, there are some individual stocks. I mean, there's some names. And some you mentioned Facebook or Meta. This stock has gotten much cheaper, and you know, this news will move the stock around a little bit. But I think some of these names like Meta, Facebook, and another one is of course Amazon, that the stocks have been beaten up really badly, are ones that, you know, they may still have further to go if the broad market falls. But they're ones that if you buy them every month, a little bit each month, by the end of the year, you're going to have a real nice nest egg there for a nice rally after that.
Cost averaging.
Thanks, Matt, for the translation. Matt Maley, talking about where yields go, and you just referenced it there in connection with tech shares. What is your expectation here? I was reading a piece by John Authers on the Bloomberg terminal just now that was talking about how bond yields, in his view, are too low if we still see mounting inflation pressures. We've got the yield on the US 10-year at 2.91%, but too high if we think that the US economy is going to roll over. Where do you sit on where we maybe end the year?
Yeah, I mean, the whole thing is this whole thing. What is inflation going to do? And in my view, I mean, I'm old enough to remember the 1970s. I was in school, but I remember it very well. And the inflation, the impact that has, it's like even with the economy weakening, if inflation stays high, interest rates are going to stay high or even move higher. So I'm in that camp that's going to be higher, and that's going to hurt a lot of technology stocks. I just think the ones that I mentioned have come down enough and have become more, their valuations have come down enough that make them a little bit more attractive than many of the others.
Did you ever see Zeppelin live?
I never saw Zeppelin live.
All right. Whenever someone says
that was big.
School in the 70s, that's what I think of. Listen, Mohammed Al-Arian out with a column that says basically there are two ways this can go, right? In terms of the Fed raising rates and then cutting. We heard James Bullard say that he thinks that's how it should go. The good way is if they do it with the support of a stronger economy. The bad way is if they have to do it to save the economy. And that's kind of the discussion we're having now, right? I mean, Marco is saying that all of this is priced in, and that's easy to believe. The question is, do you think that the economy is going to hold up or not? How important are Fed rate hikes if you have the right view on the economy?
Well, I mean, one of the things, again, I think some people are missing is that, no matter when the Feds reverse their policy, that massive emergency level stimulus, the market was going to come down, okay? It was because it was very, very overvalued. But also, we know since Ben Bernanke basically changed the way, instead of the stock market, telling us what was going to happen in the future, it was actually causing what is happening in the future. They've used it as a tool in the marketplace. Now, so in other words, the stock market coming down is going to have an impact on the economy, and we're just starting to see the beginnings of that now. I think that the economy is certainly going to weaken further. It doesn't matter that inflation's peaked. If it stabilizes at a level that is much higher than we've seen since the 1970s, that's still going to impact people. I mean, who cares if used car prices come down, if energy prices stay high and food prices stay high? That's going to cut into consumer spending. I mean, there's just no question.
And how do you view the consumer right now? Because someone like Jamie Dimon has a really unique view of the consumer. A lot of people are running around this country with J.P. Morgan Chase credit cards, right? Is the consumer starting to get stretched? Do they still have those stimmies? Have they spent them, and are they borrowing now? What do you think?
Yeah, definitely. I mean, we're starting to see, these credit card balances are starting to move up, and it shows that consumers are needing to borrow to try to maintain their lifestyle. And at some point, I mean, over 60% of Americans live paycheck to paycheck, and when you have to put much more into food and into heating your home or driving your car, that gives you less to spend in other areas. It's not all that difficult, and but it's a lot different than when we've seen in the past. And at some point, yeah, it's great when people start to borrow on their credit card, but at some point soon, in my opinion, people are going to say, something, we've got to pull in our horns a little bit. We had a lot of pent-up demand from another winter of COVID. That's kind of washed out, and I think as we move through the summer, that pent-up demand fades, people are going to be spending less.
Matt, thanks very much. Matt Maley of Miller Tabak, thank you for your time. Coming up on this program, we will talk about Meta. David Kirkpatrick, Techonomy founder and author of The Facebook Effect. What does he make of the news of the departing COO, Sheryl Sandberg? We'll get to that conversation next. This is Bloomberg.
David.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I made a final decision this weekend and let Mark know. I think, the rules are such that once I've made a decision, we do not have a lot of time to announce. So that's why the timing between decision and announcement is so tight.
That was Meta COO Sheryl Sandberg speaking to Bloomberg Technologies' Emily Chang exclusively yesterday following Sandberg's announcement that she will be stepping down from that role after 14 years. For more on this historic moment and what's next for this historic company, we're joined by David Kirkpatrick, founder of Techonomy and the author of the definitive book on Facebook. It's called The Facebook Effect. David, thanks so much for coming in early. Really appreciate
Thanks for having me, Matt.
Your take on this. I mean, when I first read this story, I thought this is a huge moment because not only is she one of the most powerful female executives in world history, right? Facebook is a company that touches more lives than almost any company ever has. So this is just could be a huge turning point, right?
Well, for much of her career, she's pretty much been the most famous business leader who wasn't a CEO, really. I mean, she is an astonishingly important figure in modern business. So it is a historic moment because in large part, Mark Zuckerberg invented Facebook, but Sheryl Sandberg invented the business. Yeah. And that's a big deal because it was the most profitable business anybody ever invented for much of its history on a profit per dollar of revenue basis. I mean, Facebook has been an incredible, historic, unprecedented profit machine, and Sheryl created that ad business. It barely existed when she arrived. So that is a massively important thing. There are, unfortunately, a lot of really painful and even sad parts of her regime that we have to also touch on, I think.
Well, and that's something one of our Bloomberg opinion columnists here, Parmi Olson, touched on in a column out on the Bloomberg. I'll read a bit from it. Sandberg's skill in growing the business came at a price for Facebook's users, for healthy discourse, arguably for democracy itself. For Facebook's critics, the company was causing damage to society because of a growth at all costs mindset driven by Sandberg and Zuckerberg. So I guess my question is, to what extent does that live on even after she's gone?
Oh, it lives on completely. I mean, I think it's very hard to know the exact machinations that happened over the last decade between Mark and Sheryl. My guess is that even though Sheryl has done way too little to acknowledge and remediate the harms that Facebook has caused in the world, Mark is more reluctant and resistant to the reforms that most rational people would like to have seen than Sheryl would have been. But she didn't really have the power. Let's remember, Facebook is an autocracy with one person having all power, unlike any other giant public company that I can think of. So I suspect that Sheryl would have done things differently if she had been the CEO, and it doesn't seem out of the question that even now, one reason she may be leaving is that she finally just got tired of not being able to really get her decisions accepted within the hierarchy of the company. That is a real possibility.
Okay, so what's the worst case scenario of what Meta looks like without her?
Well, it'd be hard for it to be much worse than it's been in recent years. That's the scary part. I mean, I have a lot of faith in the intelligence and the technical acumen of the people surrounding Mark and of Mark. I mean, Javier Olivan is an incredible business person and technologist and leader who's taking over the COO role. But look, democracy is in the decline globally and autocracy is on the rise, and Facebook is the world's #1 media platform. Those things go together because Facebook really hasn't successfully governed itself for a time. It really didn't. Mark never anticipated the power that his service would have in public discourse and discord. That was an interesting slip of the tongue, but discord has really flown from the discourse. So I think there is a strong impulse inside Facebook to try to do the right thing, but they don't really know what it is. They have 30 or 40,000 people who try to read the posts, and they don't do it in all the languages. That's one of the big, serious, ongoing problems. They've never even tried to do it in many, even most of the languages. So, you know, they can't really solve it.
And so, David, just adding on to what you're saying there about the difficulties they face. I mean, when do we need the democratic process to sort of step in and take on Facebook and take on other big tech companies? When do we see that actual showdown? Because we've seen it threatened many times.
We're seeing that now in Europe with the Digital Services Act and the Digital Markets Act, and with a bill that's being shepherded through Congress right now. That's a bipartisan effort to target Facebook, but also the other tech giants, the internet giants. The government is finally waking up to the harms that Facebook in particular has caused. They also focus on YouTube and a few other tools that are out there. But Facebook, because of its scale and because it really has become the media platform for the planet, is the most important and, unfortunately, in addition to its many positives, the most harmful. But government is waking up, there's no question.
Does it tell us anything about the future of Meta? This is a business recently reinvented as Meta, and it's clearly Mark Zuckerberg's. It's Mark Zuckerberg's. Well, you wrote the book on them, so you're allowed. But it's Mark Zuckerberg's reinvention, isn't it? Does it tell us anything about maybe other views at the top about where the company should go next?
Well, it sure does. That the leadership of the company is aligned behind this supposed vision of the metaverse, which I find highly suspect and unlikely to succeed in any near term.
I love it.
Well, you would love it. It goes with a good Zeppelin concert online, you know, in the metaverse.
You can attend in the metaverse.
But look, I'm not saying it might not happen down the road, but I'm telling you, for a service that serves 3 billion people, there is no near-term prospect that even 1 billion people want to spend most of their online time in the metaverse. That is not even a possibility. In 2030...
Don't we already do that with Instagram and Facebook?
But not with
I mean,
legs, not with no legs and, you know, weird cartoony, you know, avatars that look like they came out of a manga game. No, I don't think the world is ready for that. I think it is a vision that has a lot of power within the company, and there's a lot of people in tech that are big lined up behind it. But I don't think it is a near-term vision that's going to affect Facebook's business. The business continues to be the business it has been for the last decade. And Sheryl ran that very, very well, except for the governance part. That's you know, you always have to qualify. You know, you can't really say anything overwhelmingly positive or overwhelmingly negative about Sheryl Sandberg. She was an astonishingly effective leader who had a major blind spot.
And then there was Lean In. No time to talk about that, David, but we know that she's going on to do other things that connect in with that and the book she wrote on women in business. David Kirkpatrick, thank you very much for joining us. Techonomy founder and author of The Facebook Effect. Coming up on this program, 70 years on the throne, we'll dive into the economics of the Queen's Platinum Jubilee celebrations this weekend. This is Bloomberg.
Delhi airport, and behind me you can see SpiceJet's 737 MAX aircraft. Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Now it is the Queen's Platinum Jubilee bank holiday in the UK today and tomorrow. And many people who don't work in television will be looking forward to a few days relaxing at home. But what effects might we see on the country's economy? Laura Wright has been investigating. She joins me here on set in London. Economists expecting a short-term economic bounce then, Laura. The pubs are open late, I understand. So a chance to forget about the cost of living crisis and go out and celebrate.
Exactly. Well, forward-looking data tells us that revenge spending is likely to take place across retail, hospitality and the travel sector as we indulge in victorious sponge cakes, street parties, visiting friends and family. Data from Springboard tells us that retail footfall is expected to be up 8% this week compared to last week. The hospitality sector is projected to bring in £2 billion over the extended holiday. To put that in context, it's almost £400 million higher than a typical Thursday to Sunday trading period at this time of year. And Anna, what's really interesting is the travel sector. Syrian flight data shows us that UK flight departures up over 200% year over year. Passengers excited to travel.
I mean, okay, so this is what's happening the next couple of days, but I want to step back and take the 35,000-foot view, you know? We're talking about a 70-year jubilee. What has changed?
Well, Matt Miller, 70 years, it's probably closer to your early memories than it is for mine, Anna's or Kaylee's. But back in 1952, the population of the UK, 51 million. Today, it stands at 67 million. The average house price, £1,800. In today's money, that stands at around 56,000. But I've had a look at historical bank holidays when it's been a Jubilee celebration, such as in 2002 and 2012. And for the month when that extended holiday takes place, GDP typically falls by around 2%. Using that analysis for the quarter, it's a knock of 0.5% of GDP, which means that for the second quarter of 2022, GDP will be in contraction territory.
You see, you tried to knock her off there, Matt, but Laura Wright, she's ever professional. She brought it back to the
it's
economics.
All about the bank holiday,
Laura,
right?
thank you very much. Laura Wright here in London with the data on the bank holiday. That is it for the early edition. Surveillance is ahead with Tom, John and Lisa. This is Bloomberg.
about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think the Fed is very optimistic that they're going to see lower levels of inflation, but they're not forecasting 2% inflation anytime soon.
We think it's going to get back into the 2 to 3% range on core inflation by the end of this year.
I think we need to at least get to 4%, and that's the problem. It's difficult to do that without precipitating a full-blown recession.
I do think inflation has peaked, and I think that's going to give the Fed the ability to not tighten the U.S. economy into a recession.
Inflation has not peaked. I mean, peaked on the core level, but as far as energy and food, inflation has not peaked.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures positive 0.4% on the S&P. TK, there's a storm coming.
Oh, there's a storm coming. Jamie Dimon lightened it up, and really, Lisa, I thought some of that was off of Christian Malik in our interview that we did in London. John, it's real simple. J.P. Morgan does a lot of fancy work, a lot of math, a lot of algebra, and they're looking for higher oil prices. Maybe that's part of the hurricane.
And his chief equity strategist is still very bullish, Tom. Marko Kolanovic came out and said this: despite the steep sell-off, we believe the markets will recover year-to-date losses and result in a broadly unchanged year. That's a heavy lift for the back half of 2022.
It is, and it's wonderful to see that division at any major bank, and it's a healthy division, always part of the debate. Michael Darda coming to Kolanovic's rescue today, and Darda just saying the recession gloom flat out is wrong. He's adamant, John, off those economic data, the ones you like so much, the ISM data, that you know what? It's not that bad.
It came through pretty decently yesterday. Job openings came in just a little bit, but still elevated. The quit rate's still there, pretty high. Lisa, let's talk about crude. We're down more than 2% on WTI, on Brent as well. We've got a report from the FT. We might get more output from Riyadh, and a report here at Bloomberg that the president might be making a trip to Saudi very shortly.
We've been hearing about this. He's going to be going on a NATO tour later this month, and it might include a stop in Saudi Arabia to encourage the increase in production. The report in the FT talking about how Saudi Arabia may actually consider increasing production in response to a decline in output from Russia. How much does this matter, right? How much does this matter to diesel, to refined goods? And I think that this is actually one of the key issues. How do you translate that into lower prices at the pump ahead of the midterms?
Well, the key issue, the struggle, you've touched on it there. How do you reconcile your foreign policy goals with your domestic troubles? And right now, a foreign policy objective was almost to isolate. They never really talked about it openly, but almost to isolate the Crown Prince in Saudi. You remember that first news conference with Jen Psaki? That came up. They talked about it in the early days of this administration. And she came out and said that Secretary Blinken would be speaking to his counterpart, the Crown Prince, not the President of the United States. A little bit later, you come fast forward into 2022. Lisa, where are we? Crude's high, gas prices are up, and all of a sudden, Bit of a change.
Right. So have we gone out of the frying pan and into the fire, right? Do we isolate one and on the other hand, end up trying to buddy up with another regime that has questionable tactics and human rights violations? There is an issue here of what do you do in the near term to stave off the pain, and that seems to be the calculus in Washington, D.C., and frankly, also in Berlin. I mean, this is not isolated to the United States.
We have got a lot to get through this morning. Good morning to you. Bit of data out later this morning. Let's start with a price action. Equity futures on the S&P positive by 0.4%. Where's the Nasdaq, Tom?
Nasdaq's up.
Where's the Dow?
Up.
There you go. That was just for you. Enough now. Yields high by a basis point on a 10-year to 291.68. And there's crude.
John.
Lisa, WTI 112.76. I am not going to ask why. Lisa, pick it up.
I'll just say down because let's go there. 8:30 a.m. we do get some more of a read on the crude market. OPEC Plus is planning to meet via video conference. Will it last more than 13 minutes? That is my key question. Also, how does it bleed into the price of gas? Gas prices in the United States, the average across the nation, have climbed to new record highs day after day at nearly $4.70. How quickly can a reduction in crude prices translate into a reduction in the cost of refined goods, considering the blockades that we have seen in just actually getting that crude translated into gasoline? At 8:30 a.m. we get U.S. initial jobless claims. Notice I did not say the ADP report, which we're getting out at 8:15 because I never know what to do with it. Honestly, it's always very noisy. 8:30, the job openings I am more interested in as a follow-on to the job openings data that we got yesterday. It did come in a little bit, but still nearly 2 job openings per each unemployed American. We are not seeing the volume of people getting hired increase all that much. Again, hard to translate this data, but it really does indicate that this is an incredibly tight labor market, and it is not loosening materially. And at 11:15 a.m., President Biden is meeting with NATO Secretary General Jens Stoltenberg, as well as the National Security Advisor Jake Sullivan. Ahead of that NATO meeting later this month, I really do want to hear what they have to say, particularly about Saudi Arabia, John, because truly that will be the most interesting part of this leg of this trip, considering the fact that it is a bit of an about-face from Washington, D.C. in their attitude towards Riyadh.
Lisa, thank you. Looking forward to the coverage through this morning. TK, I'll give you 30 seconds. You can have 30 seconds. You can show us your wave.
I've been practicing my waves all
I know you
this
have.
This is the Duchess of Cambridge wave.
The clock starts now. Go on.
And this is the late Queen Mother's wave as well. I mean, John, explain this to our global audience.
No chance. I'm not playing royal correspondent for the next 2 days. You wanted to do this. You explain.
Oh, no, I can't.
Before the show started, you know what Tom said as we see these pictures? That's where they did the volleyball, the beach volleyball back in 2012.
Balcony shot. For those of you on radio, it is a balcony shot with all the pomp and circumstance, and we're looking for the various and sundry royals. Some invited John. Harry Kane rumored to be on the balcony.
Is that right? Yes. Is that the extent of your insight on the bench over in London?
Who's saving me? Vanessa Friedman. Let me have a tang here for Vanessa Friedman of the New York Times, who's been on the show many times on fashion. She's saving me this morning, John.
I'm sure you've had more than one tang.
Chris Ferrone's going, let's go. Let's go.
Let's get to Chris right now. Chris Ferrone. The head of technical and macro strategy at Strategas, a bad company. Chris, not really talked about this morning, but a German 10 years making a new high for the year. And I wonder, for the people making the conclusion, coming to the conclusion that we've seen a high of inflation, a peak in yields, can we say that when we're seeing this develop in Europe right now?
John, I think it's a great point. And, you know, when we travel around and talk with clients, I think the most consensus view on the street is that we've reached the moment of peak inflation or peak yields. The only problem with that is the market is not justifying it. It's not just German 10-year yields at new highs. Look at Aussie 10-year yields this morning. Look at UK yields. Look at French yields, Spanish yields, Italian yields. Across the board, the global bond markets have not bought into this. To this idea of peak inflation or peak yield. So, listen, peak inflation is a math problem, right? There's base effects. That'll sort itself out over time. But the reaction function of the market is what we care about. Right. And the reaction function of the market isn't buying the story.
Chris Ferrone, what is the reaction function to the opening of China?
Well, I think you're seeing it in a couple places. Number one, I think you'll get another bid in the commodity complex here. I'm not sure that's great for Europe. It's a little bit of a catch-22 here, right? We want inflation to come down, but we have China easing, right? We have a first decile PMI reading in China, which is going to incite more easing. We've seen the Chinese yuan start to weaken here. So I wonder if this actually reignites some of the inflation fears. And, you know, that's what strikes us here, right? You have CPI running in the low 8s. I can't think of anyone who thinks it's going to be higher a year from now. Everyone's in the camp that it's going to be lower. I don't think the bond market's buying that story.
So what does that mean in terms of the bullish side or the bearish side ahead?
Well, I think it means when we look at the leadership of this market, right, we've seen triple Qs, the top of the market, the growth part of the market, underperform going into this drawdown. It's underperformed during this drawdown. I suspect what it means, Lisa, is it will continue to underperform on the other side of this. I think these rallies in growth stocks or in tech are opportunities every time they bounce to get smaller in that part of the market. The market has told us this is not your leadership anymore, and that's a message that we want to respect.
Chris, just briefly on energy. I think we all hear the same voices over the last few months. We see the gains year to date, they're huge. I get some guests coming on just saying, not over-owned, not over-owned. And I sit there thinking, well, we've had a massive move this year, big move last year. How are we still talking about a segment that's absolutely ripped roared through the last 2 years that's under-owned? Chris, is that real? Is that an under-owned industry group still in this equity market?
So, John, the language we've used is energy is overbought but not over-owned. And by overbought, listen, it's 40% above the 200-day moving average. That's the most extreme reading we've seen in 40 years. It could certainly consolidate or correct from that. But it's 5% of the S&P, right? So to say it's some massive weight, that it's over its skis from a structural weighting perspective in the S&P, I think is a bridge too far. And, you know, when you think about the culture of the market over the last decade, with the proliferation of stuff like ESG, we have pushed investors away from energy. So I don't know how it can be over-owned here. We did some work this week looking at the largest ESG fund in the world. Its correlation with the S&P is 0.99. Right? So when you think about indexed returns, that's ESG versus something like energy, 5% of the S&P, I still think very under-owned.
Hey, Chris, fascinating to hear from you, as always, buddy. Chris Verone there, a Strategas. That industry group, Tom, at 58.4% year to date.
Yeah, it's going to be a play here, and we're going to see. You wonder about rotation. No one's talking about rotation, John, but I'm just going to suggest, as you mentioned with the J.P. Morgan battle between their strategist and their chief executive officer, this is the raging reset into mid-year. I'm suggesting mid-year starting 30 days in advance, June 1, and here we are. And yesterday, I'm sorry, that data wasn't the gloom cruise view.
I agree, Tom. You look at the ISM in America, Lisa, if you looked at, say, the job openings in America, the quits rate in America, the data's still pretty decent.
Is this good or bad? I'm sorry. I know that people are going to accuse me of being the absolute
from the market
gloom,
perspective.
But from a market perspective, is
itself,
that good or bad, right? And honestly, what you're seeing is the Jim Bullard school of thought getting more and more dominance. This idea that perhaps they could go up to 3.5% for a Fed funds rate, with the goal of dropping rates lower by 2023, later in the year, or 2024. How much is this becoming the base case as the economy is not slowing down because it will force the Fed to be more aggressive?
Good or bad for who, what, where? I'll tell you where and what. The 2-year, as you talked about. What happened off the back of that data yesterday, Tom? Treasury's down, yields up. Yields up at the front end, more work to do with the Fed.
Oh, we're 306 on the 30-year bond. You wonder when we get the 10-year back to a 3 right now, 2.92%. John, you know, 500 people used to park their cars on the House Guards field. It was the great perk until 1997. We need great perks on Bloomberg surveillance.
Future's up, Tom. Do you want to wave us out?
Yeah, I'll wave us out.
You wave us out.
I'm going to do a Duchess Cambridge out. On radio, this is emotional.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The price of oil fell after a report that Saudi Arabia is prepared to pump more crude, according to the Financial Times. The Saudis have indicated to Western allies that they are ready to increase production should Russian output decline substantially. The OPEC Plus coalition is meeting today and is expected to ratify a modest increase in production. Meanwhile, President Biden is likely to visit Saudi Arabia this month as soaring gasoline prices hurt him politically. The trip would mean the president would almost inevitably meet with the country's effective ruler, Crown Prince Mohammed bin Salman. President Biden has blamed him for the 2018 murder of a U.S.-based Saudi journalist. And Sheryl Sandberg helped turn Facebook from a startup into a multi-billion-dollar advertising powerhouse. Now she's calling it quits. Sandberg is stepping down as Chief Operating Officer of Facebook parent Meta Platforms. After 14 years, she served as the highest profile face of the company next to CEO Mark Zuckerberg. But she was criticized for the company's failure to rein in large-scale misinformation and privacy breaches. Russia says it is ready to settle claims on bonds that were judged to have breached their terms after missing a $1.9 million interest payment. It's an attempt to avert an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said a failure to pay event occurred on credit default swaps. Russia blames foreign counterparties for the delay. In Tulsa, Oklahoma, police say a gunman killed 4 people at a medical building, the latest in a series of mass shootings in the U.S. Authorities say the gunman apparently killed himself. It's unclear what led to the attack. Police say they were on the scene about 3 minutes after getting a report. Global News 24 hours a day. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. May jobs are in focus.
There are 11 million open jobs.
And you wonder how that folds into the future of the American labor economy.
Friday, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
The labor market is starting to get a little easier.
95% of the jobs that were pre-pandemic have recovered.
Because there's more resiliency in the economy.
The May Jobs Report, Friday on Bloomberg Television and Radio.
It's a hurricane. Right now it's kind of sunny. Things are doing fine. You know, everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy.
Jamie Dimon making some headlines in the last 24 hours. The JP Morgan Chase chairman and CEO.
Wow.
TK, what did you make of that yesterday?
I think magnitude is the issue here. In economics, one of the great divides, John, is sophomore year, they start talking magnitude and they look at it on a log basis. He gives you the magnitude of the hurricane, but one of the issues here for Chairman Powell is you don't have a hurricane and you ebb away. And what you get, John, then is a longer-term inflation. If you don't get the cathartic recession, we get the longer-term inflation, which crushes the middle class.
In many ways, Tom, wasn't he just stating the obvious? There's some storm clouds brewing, there's some trouble on the horizon. Might be a weak hurricane, might be a strong one.
I give great credit to Lisa for driving Brian Moynihan and Davos toward actually talking about the banking business. I mean, I'm sorry, John, a lot of these CEOs now want to go all macro all the time, and I just wish you'd read Kasman and Feroli, who are not calling for a hurricane.
Elisa, I think that was a subtle dig there from TK. I will say, if you take the more complete quote from Jamie Dimon, he does end up by concluding about the bank and what he's doing at the bank because of the challenges that they face, and maybe just lightening up some risk with the balance sheet because of what we could face further down the road.
Although, let's be honest, Jamie Dimon usually when he gives these speeches comes off more, and this is something we were talking about earlier, as a statesman or trying to be a figurehead rather than a leader of a bank? And does it sort of indicate where his role is going to evolve or where it should evolve in terms of the eyes of people who would like to see some sort of predecessors come up and try to get through the ranks?
We got to do this quickly before Jack Fitzpatrick on Washington politics. Lisa talks about figurehead. John, let's go to the Jubilee in London. And in the front row, separate from the royals, is the Prime Minister. They showed Prime Minister Johnson earlier. Is he on the edge of Theresa May, John? Is he really threatened?
You're going to do your utmost to make me the royal correspondent over the next 48 hours. I'm not playing.
Okay, but the Prime Minister, is his job really threatened?
That's up to him, Tom, about whether he wants to resign or not. Would people like to see him step down? Some people would, yes, after the Partygate scandal. Others still support him. That's the balanced view.
Is this how Tom's trying to get you to play into the Jubilee, is to ask about Johnson's future?
I don't know where this is going. Are you trying to transition from there to the Queen's future?
I'm going to transition.
Where do you want to take this?
I'm taking it to Jack Fitzpatrick, who's going to save us in Washington, capital of the colonies, right now. Jack Fitzpatrick, the president I know, is riveted to the Jubilee as well, but there is no Jubilee at the White House. Let's go to what we need to talk about on Thursday. Does he need to shake up the White House to get to the Sunday talk shows?
You know, there's been, I guess, murmurs about when there might be a White House staff shakeup for a while now, because you see the White House kind of responding frantically to a series of crises, and the pressure he's faced and really kind of the lack of answers from the White House on why the president didn't know more when the FDA should have told him more about the baby formula shortage. All of that seems to lead to those questions, but I'm not entirely sure at what point the pressure builds enough so that somebody's got to go. Obviously, at this point into the presidency, it's kind of been dominated by responses rather than sort of fulfilling his vision. It's been responding to crises, but he hasn't expressed frustration outright with anybody in particular.
Jack, you've been covering politics in the Beltway for a long time. How unusual is this feeling that this president, his administration, is constantly behind the 8 ball, whether it's with infant formula, whether it's with gas prices, whether it's with inflation, whether it's with how things are developing on the labor front? How much do you get the sense that this is a uniquely behind White House versus run-of-the-mill, classic, hard to gauge, a very fast-moving economic cycle?
I think it's not that unusual for the news cycle surrounding the president to be responding to crises, especially in the environment we have in Washington right now, where even a fairly minor crisis could be ginned up into something bigger as you get close to the midterms. But it is the set of circumstances right now are pretty extreme. So obviously there's not a lot of history to go by for how you respond to opening up during a pandemic. It's a very difficult set of circumstances, but also it's not unheard of for the presidential news cycle in recent history to be dominated by pretty negative news and struggling to respond to a crisis.
Jack, there is this issue now of whether or not the president's going to head to Riyadh, whether the president's going to head to Saudi Arabia to try to have some sort of communication and a better relationship to induce more oil production from that region. How is that playing in Washington?
I'm not sure exactly how much pushback there are going to be from Democrats if there is really an easing of the relations between President Biden and Mohammed bin Salman. Obviously, there's some leftover angst over the killing of Jamal Khashoggi, and there are a certain number of people who supported the president's initial view that he would only directly communicate with the king rather than the crown prince. It's not an issue that lawmakers are bringing up over and over again. It's a bit sad to say, but about 4 years having passed, it's not something where the political pressure has continued so much that you could I guess expect an immediate massive amount of pushback toward that. There may be skepticism, but we're not hearing a bunch of preemptive pushback from allies of the president right now.
Hey, Jack, great to catch up. Jack Fitzpatrick there, down in D.C. Crude lower this morning by 2.5% on WTI 112, TK Brent crude 113.
Yeah, 113 off of it, and we'll see where that goes. John, I'm going to bring it over to FX. I don't think we've talked enough about resilient dollar here with yen buttressed up against a 130 weak yen over weak euro pretty much the last number of days. It's beneath the radar, but I'm watching the deepest market to see some of the tones here as we go to that jobs report.
And looking ahead, beyond the jobs report to next week in the ECB, Bramo looking at yields in Germany, new highs for the year. This morning, new highs for the year.
Yeah, and if you take a look at what people are gaming out, they're now seeing the likelihood of a 50 basis point rate hike, possibly as soon as September, in Europe, right? This was off the table. This was an unheard of reality, and all of a sudden you have even members of the ECB considering this, and this comes in the heels of what we saw from Canada yesterday. And yes, I know, who cares about the Bank of Canada? I do. It was actually really interesting.
I never said a word.
Well, I know, but it was actually.
I like the Canadians.
I know, the Canadians, how can you not like the Canadians?
I love the Canadians.
They're wonderful, but honestly, they also set the tone often
yeah, but
for central
banks.
banks.
Defense. I mean, they need defense, and the power play just isn't there.
What are you talking about? Hey, TK, do you want to wave us out? We'll do this every
here
segment.
We go.
Wave us out.
The balcony scene's coming up here. It's coming up. Okay, and then the Duchess of Cambridge is sort of this kind of thing.
You're not missing anything.
How am I doing?
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
No real drama here this morning. Good morning to you all. Futures just about positive on the S&P and the NASDAQ, up a third of 1% on the S&P 500, on the NASDAQ 100, up a half of 1%. Marko Kolanovic over at JP Morgan thinks we can recover the year-to-date losses. On the S&P, that's about 18% away. It's quite a rally you can expect into year-end if you believe that is the case. JP Morgan and the team thinks we can avoid a recession. And Tom, one ingredient for that rally, stimulus out of China. Marko Kolanovic very focused on that particular factor to push us back up.
We mentioned that with Christopher and Johnny. 100% agree. I'm not sure, I'm no expert on it, but I think we're way downplaying China at reopening. John, let's do the drawdown right now as part of your data check here, folks. It's not that gloomy out there. The Dow down 10%, SPX midway. But John, look at the damage in the NASDAQ.
I like how you led with the Dow and then you want me to take you seriously.
Yeah, the NASDAQ.
The NASDAQ's been brutal. It's off the lows though, Tom. Big move last week. What we saw in the month of May to close out May, Marko and the team thinks that's a template. They think that's a template for the rest of the year. We'll see. That's the call from them. And I got a lot of messages yesterday about whether Marko and Jamie should have a chat, a conversation.
Oh, now come on, it's healthy.
To work things out.
It's healthy. No, I don't agree.
Hey, Tom, it's not my view. Just presenting the views of many
questions about
people.
the Jubilee.
That's what we do here. We're not going to talk about that.
Of the Jubilee.
We will talk about the bond market. In Germany this morning, yields making new highs for the year, through 120. On a 10-year, back to 290. And all of a sudden, we're thinking about 3% again. After topping out at 320 at the start of May. On a 2-year yield, 265. Yields high by about a basis point. A lot of this coming about off the back of decent data in America. And the idea being that this Federal Reserve, Tom, has more work to do.
John, I agree totally. Folks, I want to make clear with the Jubilee and with these guys with the hats on, we're having the Royal Tang this morning, John.
I think you've drunk enough Tang already.
It's like a little, it's a thing,
31 minutes
it's a little shot of beef fevers here with the Tang.
Left. You enjoy yourself. I'm going to get to crude, WTI and Brent.
Please.
And I'll just finish up on this. 2 reports this morning. One from the FT, the Financial Times, reporting that the Saudis could be getting ready to pump more crude. That plays into the story we heard from the Wall Street Journal earlier this week. The second story came from the team here at Bloomberg that maybe this president is thinking about a little bit of a visit to Riyadh later this month, Tom. That's teeing us up for perhaps a loosening of this commodity market. Brent and WTI lower by about 2.5%.
Helena Croft writing this morning with RBC. She's looking for a great bargain as a possibility between Mr. Biden and the royal family in Saudi Arabia. Sarah House joins us now on the American economy and, yes, the seriousness of the jobs report tomorrow. Senior economist at Wells Fargo. Sarah, I want to talk about fully employed America. Which America is fully employed?
Well, I think when you look at what part of America is fully employed, I mean, the job demand that we're seeing, it is broad-based. And so we're seeing it across various sectors. So whether it's the professional services, but also in terms of some of those lower paying service sectors where we've seen hours tick up. And overall, when we look at the U6 unemployment rate, so that is broader and includes some of those part-time for economic reasons, we've seen that near record lows as well. So I think by and large, no matter how you slice it, while I think you are seeing a very tight labor market right now.
I'm being told by people, Sarah, not Wells Fargo, that the chairman of the Federal Reserve wants the unemployment rate to go up. Who in America should lose their job so the unemployment rate goes up?
Well, that's why it's so politically sensitive and why the Fed officials will never come outright and say it. But I think implicitly they do need the labor market to cool, and that's probably going to involve the unemployment rate ticking up just to relieve some of the inflationary pressures that's stemming from the labor market. So if you look at the unit labor cost trends, we'll get an update on that this morning, but they're trending at roughly 5%. And so that implies either steep compression in margins or still significant inflation coming from the labor market. Fed can't do much about semiconductors. They can't unload ships out the port of LA, but they can impact that labor portion of inflation.
Sarah, which aspect of the labor report that we get tomorrow is going to be most important to the Fed?
So I think a lot of it is going to be focused on participation. You know, the headline always matters in terms of how many jobs we're adding, what the pace is relative to what we've seen previously. But I think so much of the job outlook, and again, how tight this labor market is and how much tighter it could get, comes down to what we see on the supply front. So we saw a step back in participation last month. I think that's probably more noise than signal. And we expect participation to trend higher as some of the constraints that have been holding back workers, so things like health concerns, maybe some of the childcare constraints continue to ease, and some of the financial needs among households grow. But I think we are seeing in some ways, like if you look at the prime participation rate, it's already recovered quite a bit. And so there's still some questions about how much further that can go and really how much slack there is still left on the sidelines to help alleviate some of the current tightness that we're seeing.
Taking a step back, Sarah, last week people were talking about a potential pause in Fed rate hikes come perhaps September. This week, people are rethinking that, and all of a sudden the data is showing ongoing momentum and, frankly, inflation continuing to be not only sustained but increasing, particularly in the services sector. How do you view the Fed's actions in response to this and the likelihood of a Fed pause at some point later this year?
So I think the likelihood of a Fed pause this year is very low. If you just step back and look at what we're seeing out of the primary mandates, inflation, and the labor market, both of those are still red hot. And I think we've seen officials at least agree on the fact that they aren't going to really be able to ease off the brakes until they see inflation slow in a definitive manner. I don't think we're going to see that until very late this year. So I think we're going to see headline CPI stuck essentially around 8%, probably through October, which means the Fed won't even see that till November. So I think the talk of the Fed pausing is premature at this point.
Sarah, this idea of seeing inflation come down in a definitive manner, what does that mean? What is the number behind that? Have they told us that? Do we understand the threshold?
They haven't told us, and I think it's in part going to be driven by composition. So I think it's going to matter what's happening with the core. So if it's elevated from the point of energy and food, which I think will be a big source of that, then I think if they're seeing that core decelerate, they might feel better about a slowdown. But I don't think it's any one particular number that they have to see. But I think it's slowing more on a trend, and at least nowhere near the 8% rate that we're going to be stuck at here.
Tom, this is the problem here. This stuff is pretty vague. And these calls about a Fed pause, what's behind them right now? And are they being endorsed by Federal Reserve officials? I think it was Raphael Bostic, the Atlanta Fed president, last week that made the point that maybe we could have a pause. He was keen to point out this week with Market Watch in an interview, Tom, that wasn't about a Fed put. He had very little interest in that whatsoever.
Yeah, and it's all data dependency. I mean, they're going to make this. John, you do the calendar out of inflation reports. I'm sorry, that's the major thing here. And then I'd overlay the jobs report as part of the dual mandate of the Fed. They're massively data dependent.
And the reset in Jackson Hole. And Sarah, I'd love to go there with you. We're doing our planning for the rest of the year. We were talking about Jackson Hole yesterday and thinking that's somewhere we need to be. Do you think that could be a big moment for this Fed?
So I think, Jackson Hole always has a lot of attention. I think given how quickly things are moving in both the markets, the economy, and Fed policy, I think it could be a forum for another big indication of where the Fed goes. But I think when we look at where we'll be in August, we'll still be dealing with the same problems that we have today. So the fact that we are still seeing this elevated degree of inflation, I think we'll still be looking at an overly tight labor market. And so I'm not sure how much of a shift in Fed tone we'll see. But again, things have been moving quickly and a lot could change. And I think there is likely to be a lot of focus and, at least some guidance on where the Fed could go. But I don't think the circumstances will be all that different from where we are
Sarah
today.
House of Wells Fargo. Sarah, thank you. Setting us up later this year for the year ahead, Bramo, this Federal Reserve, in the words of Sarah House, is not set up for a pause anytime soon.
And frankly, a lot of people agree with her, and yet you're not necessarily seeing that in the market. There has been this pause that people have experienced as far as like a sigh of relief, and how much can we actually get to the aggression that the Fed is saying that they are going to have, and frankly, that the data is confirming.
What did Bill Dudley say on this program yesterday, the former New York Fed President, Tom, on that Fed pause? He said, I would not put too much stock on it. The market is priced to a peak in the federal funds rate of 3%. The Fed will probably actually have to push beyond that ultimately. The former New York Fed president, Tom, still very hawkish.
Some serious clout there with the Berkeley math and, of course, decades at Goldman Sachs as well. One of the big differences, John, with Bill Dudley is he actually has gone through the pressure of forecasting. There's a certain humility to what he does rather than selected presidents tossing out media-friendly statements.
Would you like to tell us who those selective presidents are?
No, I wouldn't like to do that. John, we go to Jackson Hole. We're working on it right now. We'll see if it happens. But, John, you and a pair of Tony Lamas, I can just, I don't think, John, you want to go
the Tony... translate?
Tony Lama two-tones, but you want to go with the Leviathan boots. They got the sort of the ostrich kind of like South American lizard thing going.
About?
They're sort of a Brazilian kind of Tony Lama.
Okay. Do you want to explain a little bit more about why I need what these are?
Because you got to wear the Western garb out there.
He's coming up with your wardrobe.
He's doing our wardrobe.
We're going to you do a full English in London, John. At the Pioneer Grill at Jackson Hole.
What do they serve?
You do a full Teton.
Okay. A sea of mushers, Bramo called it.
Different mushers.
Which I'm never going to forget, Tom.
Okay, that's the reason why
I'm
not
talking about the Jubilee.
Do you want to take it back
on this Jubilee celebration?
I like Stefan toast. I don't want to take that back. It was really good. It's gotten to a lot of precedence. Yeah. People talk about, avocado toast here in the U.S. I'm just saying.
John, can we talk about a business transaction,
sure,
which is maybe the future of sports?
I get a feeling where this is going, yeah.
AC Milan taken out by Redbird with some bolt-ons. This is a company that doesn't buy a majority. They're really good at going in and buying a hunk or a bit. This is Jerry Cardinal. They got some Fenway linkage as well. But I really wonder if this is the future of sport.
1.2 billion. And Tom, I think shout out as well to Elliott Management. Who would have thought that hedge fund would end up owning a football club? And they did it in a very strange set of circumstances and really helped turn around that team too. Tom, here's a tweet for you. Most annoying anchors of Bloomberg, Tom Keene, Ferro. Best examples of how to talk over one another with useless banter.
There we go.
More than any useful business news. We do it just for you. It's just for you. And we're going to do a little bit more for you in the next segment.
Yes, futures up 20.
The segment after that.
S&P
the one after
futures
that.
Up 20.
What's the hate about, Tom? Where's the love?
You got to do a show, John, and at any given time, 42% of the people have to hate you. Thank you.
You've got to upset someone. From New York, this is Bloomberg.
Lisa, we upset.
Keeping you up to date with news from around the world with The First Word, I'm Ritika Gupta. The price of oil is falling today following a pair of reports. According to the Financial Times, Saudi Arabia has indicated it's ready to pump more crude should Russian output decline substantially due to increasing sanctions. Meanwhile, President Biden is likely to visit Saudi Arabia this month. That could lead to an increase in Saudi oil production. Soaring gas prices are hurting the president politically. Banks in China are facing growing pressure to support cash-strapped property developers. Regulators have been pleading for months, but that hasn't boosted lending to the industry. Builders and regulators are counting on banks to provide a lifeline as bond funding and home sales dry up. In Virginia, a jury sided with actor Johnny Depp in his libel lawsuit against ex-wife Amber Heard. Jurors awarded him $10 million and vindicated his allegations that Heard lied about Depp abusing her. But the jury also found that Heard was defamed by one of Depp's lawyers and awarded her $2 million. The crypto business run by billionaire brothers Cameron and Tyler Winklevoss is making its first ever job cuts. Gemini Trust is slashing 10% of its staff as trading across the industry plunges. In a memo seen by Bloomberg News, the brothers blamed the job cuts on what they called crypto winter. Last year, Gemini said that it raised $400 million in a round of funding that valued the company at $7.1 billion. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
as we get tangible evidence that inflation is definitely retreating, then we could look at reducing the policy rate in future years, 2020, maybe late 2023 or 2024.
Jim Bullard, the St. Louis Fed president, can we just sit on that for a moment? The idea that we could be looking at reducing the policy rate in 2023. Tom,
come on.
That's next year.
Look, Deutsche Bank goes out with a recession call to late 2023, and I'll give them some slack on that, and that's their job, is to look out like that. We've got Fed presidents doing the parlor game out a year and a half, John. At least I can say that's original.
Well, Tom, it's original to talk about bringing down inflation, get rates up to 3%, maybe more, and perhaps do that by the end of this year and then talk about cutting interest rates next year. Should that even be part of the conversation?
Exactly.
There's always two-way risk around a policy story. I get that, but I just don't see the value of making that comment
we had to move beyond Arthur Burns' smoke rings and the very narrow communication strategy of Alan Greenspan. But, John, to me, it's out of control.
Futures right now, Tom.
Up
0.6 of 1%. That's your move.
It's out of control.
We're both out of control.
Let's go to London right now. Professor Norman's going to join us here in a minute. But on radio, you need some pageantry. They're trooping back and forth on the beach volleyball court of 2012. The Horse Guards, 240 horses involved. There's a good shot of the sand. Nailed that, Amy. Absolutely nailed that shot. There we are as they move through the morning. 14 of the lads are from Coventry, all growing up with John Farrow. Right now, Julie Norman joins us from UCL. We're going to do a little explanation here. Professor Norman of the University College London, how does a jubilee fit in to the total political chaos I read every day of the United Kingdom?
Well, Tom, I will say there's definitely a sense of respite this weekend, a break from the political slog that really has been plaguing obviously the Conservatives, but both major parties. And alongside with that, we've heard a lot about U.S. inflation, but inflation in the U.K. is up around 9% as well, is not coupled by growth. So people, especially outside of London, have really been feeling the economic strife, the political strife, and also just coming out of 2 years of lockdown and COVID. So I think this weekend people are ready to celebrate and get back to business next week.
John from Milan emails in and says, get off the Jubilee stuff. So Julie, let me segue here over to what you just said, which is the city focus of our modern time. Everything's about London prosperity, everybody else flat on their back. Everything's about Paris prosperity, everybody's flat on their back. I mean, that's the modern political economics, isn't it? The strength of the city.
Well, it certainly is to a certain extent, Tom, and I've definitely seen that here in the UK. I mean, the current growth reports here show that 6 out of the 8 areas of England are actually having negative growth. London, obviously, there's some marginal movement forward, but in most of the country, reality is much different than it is here in the capital. I think that's something that's underappreciated by a lot of the political parties and as well as even many of us in academia. So we see that here, we see it in the US and in many other parts of the world where I work as well.
Julie, talk to me about the political lessons in the UK when it just comes to policy. Sometimes I look at the policies coming out of the Conservative Party and the lines are blurred between left and right. The windfall tax, I remember, of course, the early 80s is something a Conservative Chancellor has done before. But the opposition accusing the Conservatives of borrowing their own policies. What do you make of that?
Yeah, well, it's interesting following the policy here, John, because as you noted, there's a bit more crossover than there would be in the U.S. Even many conservative policies to many Americans would look a bit more liberal or even progressive at times. Obviously, it's not always perceived that way here, but it's a situation here where I just think, you have a very weak opposition. Labor has not really been able to reorient themselves around any kind of strong leadership. And so it's kind of create a system where you have 2 relatively weak, relatively moderate parties in power and not a lot of progress. And obviously, there's more calls for Boris Johnson to step aside from within his own party than from anywhere else. So we see a lot of internal wrangling, a little bit more than we do in the United States, where there's much more of that 2-party, kind of back and forth between and not as much within.
Julie, how much has the UK really set the tone when it comes to that windfall tax? How much do we expect to see something similar in the US?
Well, it's a good question. I mean, there's been a lot of different relief efforts that have been put in place in the UK, even under the Conservative government since the start of COVID, that we would not have seen the equivalent in the United States. And that's just partly because of the system and partly because of the expectations here. So even though some of the policies here, I think, work, I think they'd be a lot more risky and also just have some questions about feasibility
the United States as well.
And now we go to our surveillance journalism. John Farrow, with great respect, should the Queen pay a windfall tax on her substantial assets?
What are you suggesting that should look like, Tom?
I don't know. I just wonder. I mean, I think it's been underplayed for decades and decades, the accumulation of wealth over the years, not overtly by the Queen, but just the fact that they own half of the ground that you trod. I mean, what portion of Heathrow do they own? And the answer is, should they be paying a windfall tax in trying times for the United Kingdom? Professor Norman, please.
Well, John, Tom, I'm not sure about that one. I think the Queen is just going to be enjoying her weekend this weekend. But yeah, in terms of the taxing kind of system, there's things that I think they can push here and that people in the UK expect, and it's something that in the US would just probably not fly to the same level.
Julie, very diplomatic.
Nice.
Thank you. That was actually wonderful.
That was a great punt.
Julie Norman of the UCL Centre on US Politics. Thank you. Tom, I went through the polls this morning over at YouGov. This is questioning all Britons. Should we continue to have a monarchy? 61% said yes. But if you go by age group, listen to this breakdown by age group.
Please.
65 plus, 81. 50 to 64, 70. 25 to 49, 53. If you go to 18 to 24-year-olds, that age group, as low as 31%. Yeah. That's what the future looks like, Tom, for the monarchy at the moment.
I'm fascinated from it, but Lisa, at the heart of the matter is we are the colonies. We are from a distance.
Yes. Correct. That's why I'm not going to weigh in.
Lisa. Boy, John,
well, I mean, honestly, where am I supposed to go with that? I don't know anything about the Jubilee. I'm not going to pretend. I'm not going to try to tweak John with fake knowledge. I'm not going to do that.
Can I get more beef eaters in the tank, please?
Tom's going to keep trying. We've got another day of this, Bramo.
Oh, no.
I thought I was getting a day off.
I didn't.
Thought I had tomorrow off too.
You know, I did not put it in my brief. I just want to put that on the record on purpose. I thought about it, and then I was like, you know what? It's going to be a distraction all day anyway.
It's a distraction, all right. Futures look like this on the S&P, up 0.6%. If you're just tuning in, equities higher on the NASDAQ, up 0.8%. What have you missed, Tom, if you're just tuning in?
Sterling is 125. I got to go back and calculate what it was like.
I do want to talk about crude. 112 handle on WTI, 119.98. The highs at a week on WTI. Two reports out today. One report suggesting from here at Bloomberg that the president could visit Riyadh later this month. Another report from the FT suggesting we could get some higher oil output out of Saudi Arabia. Just weighing on the crude market this morning, Tom.
John, this is important. This is what surveillance is about, folks. In 17 minutes, Christian Malik will join us, not to go after his boss, but to frame out how commodities, and particularly hydrocarbons, play into the stress you hear in James Diamond's voice.
You have to ask him if a hurricane is coming. Tom, that has to be the lead question.
I mean,
to
be fair,
from JP Morgan this morning, that has to be the lead question. If you're a client, you're asking that, aren't you, Tom?
Yeah, I think so. I would also want to know where Christian's going to celebrate the Jubilee.
You can ask him in a moment. Futures up 0.6 on the S&P, on the NASDAQ up 0.8%. Another nice morning of gains, hey, Bramo?
Yeah, beautiful.
Yeah? Let's see if they last. From New York City, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think the Fed is very optimistic that they're going to see lower levels of inflation, but they're not forecasting 2% inflation anytime soon.
We think it's going to get back into the 2 to 3% range on core inflation by the end of this year.
I think we need to at least get to 4%, and that's the problem. It's difficult to do that without precipitating a full-blown recession.
I do think inflation has peaked, and I think that's going to give the Fed the ability to not tighten the U.S. economy into a recession.
Inflation has not peaked. I mean, peaked on the core level, but as far as energy and food, inflation has not peaked.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures up 0.5% on the S&P. More data still to come this morning stateside. And Tom, the data so far, so good.
So far, so good. And it's going to be interesting on claims and on jobs data tomorrow, John. And maybe you get a reaffirmation of recession. Well, maybe not. Michael Darda leading the way with a terse note this morning that the gloom crew is flat out wrong. The Fed is fighting the last war.
You saw the reaction in the market, Tom. Yields higher, treasuries lower. The conclusion, the Fed has more work to do.
Dollar resilient as well, which is, rates come up. Money flows to the dollar. Have we broken through? No. Is there any drama in the data check this morning? No. But the fact is we've had a real reversal of the gloom.
Speaking of reversals, there is some drama in the commodity market. It's somewhere, it's there, in WTI and Brent. We came so close, Lisa, to 120 on WTI this week at 119.98, and then a big turnaround and another one yesterday.
With Saudi Arabia possibly increasing production, according to a number of reports, including from the Financial Times, in response to a decline in output from Russia. First of all, how do you gauge the decline in output from Russia, given the fact that a lot of their oil is floating on ships to China right now, right? So that's number one. But number two, at what point is this willingness, a tit for tat with the U.S. government? How much does this depend on President Biden heading over to Riyadh to make peace with the leader of Saudi Arabia?
And how much do some of these oil calls depend on China buying more crude from Russia? JP Morgan, will catch up with them in about 10 minutes, came out with this line. China needs to increase its purchases of Russian crude by 1 million barrels a day. If that doesn't happen without China, Brent crude could average 122 in the second quarter, peaking at a monthly average of 136 in June. That's painful.
How much visibility do we have? I mean, we talk about all of these corporate executives coming out with just this question of we have no idea what's going on. How much visibility do we have when people are tracking with GPS systems the tankers heading to China from Russia because they're trying to move under the radar? I mean, just to give you a sense of the uncertainty in the direction of oil prices.
Well, that's the issue you have in the C-suite right now. So Jamie Dimon yesterday making this point, Tom, I think it's where the emphasis lies that's important now as a corporate leader. What do you do if you think the storm clouds on the horizon? You prepare for those kind of things, Tom. Yeah. You brace. That was his point.
The corporations are going to adapt. That's all there is to it. Again, Christian Malik coming up here in 13 minutes. John, I would really make a point here of the commodity move that you mentioned. Bloomberg Commodity Index, which frankly is better math, did not go out to a new high yesterday. But Doug Cass down in Florida notes CRB, which is the old school. You'd figure from Cass, a Yankees fan, he quotes CRB. That does break out to a new high.
Equity's breaking out just a little bit, not really this morning, up 0.5% on the S&P.
Nice.
I'll whip through it for you on the NASDAQ 100, up 0.6%. Lisa keeps calling these nice moves,
No.
just nice moves.
It's a nice move.
Just nice moves.
No, you were the one who called it that, and then you're going to put that on me.
Very frustrated, Lisa.
Well, I did not call it that.
Just let me get to the bond market. It's meant to be a day of celebration for the Queen. 290.76.
I'm going to quote you on that.
Yields unchanged, Lisa. At 291.
So a day of celebration. We're not going to let that go, John. 8:30 a.m. OPEC Plus is meeting via video conference. How long do they actually meet for? That's my big question. Also, Wizard, more of an indication from Saudi Arabia that they're planning to increase production to offset a decline from Russia. How does this trickle out into gas prices, right? There's been this disconnect between crude and the refined goods. And in the U.S., you are seeing gas prices continue to climb to record highs. How much further does it have to go, and how much can lower crude prices in the near term really change that dynamic all that much? At 8:30 a.m., U.S. initial jobless claims. How much does this follow on to this feeling of tightness that we got yesterday with that JOLTS data, with that job openings data? 2 job openings nearly per each unemployed American. Where are the workers? When are they going to come back? What's the participation rate looking like? And are we starting to see a number of businesses say, you know what, we don't even need the workers. We're just going to cut those positions. And perhaps even some of the people who we've hired, whether it's Amazon or Walmart, we're overstaffed for the moment that we're in. And you start to see that tick up in the jobless claims that we get at 8:30. And at 11:15 a.m., President Biden is meeting with NATO Secretary General Jens Stoltenberg. Also joining the meeting is Jake Sullivan, National Security Advisor, talking about that June meeting, the NATO summit in Madrid. Again, I want to hear about President Biden heading to Riyadh. How problematic is this from a political perspective, given the fact that there's been a huge rift between these two nations, and there's been a feeling that the U.S. shouldn't get too cozy with the Crown Prince Mohammed bin Salman? How much does that actually end up being a sticking point, or is there some sort of support more globally from NATO?
Elisa, you'd have to believe that he's just drowning overwhelmingly in domestic issues. And that gas price every morning, we talk about it with Anne-Marie every single morning. That's a major problem for him.
It's a major problem for him, and it's also a major problem for all NATO nations. So do they band together and try to somehow bring Saudi Arabia back into the cause, back into the fold because of that necessity?
Bramo, thank you. Big week ahead. Payroll's coming up tomorrow. Kathy Jones joins us now, Chief Fixed Income Strategist at the Schwab Center for Financial Research. Kathy, 120 on a German 10-year this morning. For all this talk of peak inflation, peak yields here stateside, on the other side of the Atlantic, can you make that call yet?
Yeah, I don't think we're quite there, just because Europe has been lagging the U.S. in terms of this cycle. But I don't think they're far behind either. We're starting to see that catch up. We're starting to see the market build in the expectation for a tighter policy in Europe. So I think they're lagging us, but I don't think they're quite there yet.
Kathy, the yields that we see are a complete mystery out to third quarter. What does your top end look like? How far up do you frame yields could go to?
So when we're looking at the short end, we're still looking at the Fed tightening 50 basis points the next 2 meetings, and probably then switching to about a quarter point increases in the fall. And we see them topping out, probably in that 2 3/4 area. We're a little bit under sort of the consensus and what's built into the market. When we look out to the 10-year, our expectation is the upper end is that 3 to 3 1/4 area. As you get into a tightening cycle, yields converge across the curve. We're already seeing a little bit of inversion from 5s to 10s. So we think 3 to 3 1/4 is the upper end of what we're going to see.
Kathy, we're talking this morning about the two-sided argument within each of these houses at banks and beyond of whether we're too gloomy or whether we're too optimistic. And the data is coming out strong. Does this mean that the Fed has to go much harder? That basically, yes, you could take that 3 and 3 1/4% 10-year yield, but the path to get there is one paved by a Fed that essentially has to end this cycle, has to create a downturn.
Yeah, it certainly is the way that, they're talking right now and have to take them seriously. It's pretty much across the board from Daly to Bullard. You're hearing the need for tighter policy. And I think that this cycle reminds me of the early 80s. Tom might remember this. But, you had high inflation, relatively healthy economy. And the idea was just to, really get that inflation down. And Volcker at the time came in and just jacked up rates until we tipped into a recession. We had 2 back-to-back very sharp recessions. So that's kind of the risk, I think, if the Fed goes really hard here. But that certainly sounds like the intention that they have.
Kathy, how achievable are these forecasts over at the Federal Reserve? Unemployment at 3.5% this year, 3.5% next year, 3.6% the year after that. How achievable is that?
I'd say that's aspirational. It would be surprising to me if you could have the kind of monetary policy we're getting with higher rates and QT, along with the global tightening cycle, and still keep unemployment near 3.5%.
Do you think they should rename the summary of economic projections Federal Reserve aspirations?
I think so. They're never going to forecast failure, right? So
true.
They have to forecast, what they hope happens.
Kathy, thank you. Kathy Jones at the Schwab Center for Financial Research. TK, the aspirations of the Federal Reserve.
Oh, there's not much to talk about here, John. They're going to go. Their aspiration is to wait and wait and wait. Every central bank does this. It's Alan Meltzer 101. They are data dependent. What's interesting, John, as we heard from Mickey Levy yesterday, and this goes to James Bullard, who we heard earlier, is even if there's a whisper of targeting, that forces them to move higher.
You like that line, Lisa? They'll never forecast failure.
Yeah.
Plenty of people are doing that for them.
Well, yeah, and they've got a credibility issue if they don't acknowledge that and indicate that that is a high likelihood. And that was what we're hearing a little bit more from Fed Chair Jay Powell. But that is a conundrum. They can't forecast failure. But if failure is a slowdown in the economy, isn't that kind of the goal right now? I mean, what is failure right now?
The objective. The policy objective was to tighten financial conditions and take out some demand. To do that in a way where we don't get higher unemployment, we don't get a recession, that's really tricky.
Especially because right now, that inflation is not coming down on its own. Right now, the labor market is not slowing on its own materially in a way that can give the Fed any comfort. So what do they have to do to get to that end? Looking forward to the coverage through this morning. We'll have a conversation on commodities, on crude more specifically, with JP Morgan in just a moment. Looking at crude this morning. Good morning. Crude lower, 112 on WTI, backing away from 120 earlier in the week. Equities doing okay, up 0.5%, but it's the oil market once again that gets your attention, Tom. Those 2 reports, one from the FT, one from the team here at Bloomberg. The FT indicating the Saudis could be getting ready to boost output, reflecting some of the stuff we heard from Dow Jones earlier this week, the Wall Street Journal, of course. And then here at Bloomberg, Tom, a meeting potentially between the President of the United States and the Crown Prince Mohammed bin Salman in Riyadh, Saudi Arabia.
The meeting's way, way important as a symbol, and you really wonder the calculus, and I mean truly the royal calculus the Saudis will have.
The royal calculus. Any more to say on the royals?
No, we're like going down a street. They're like, I think they're on their way to Claridge's for a full
That's the
English.
Coverage. That's the coverage of the Jubilee. They're like going down a street.
Full English, $50, John. Claridge's, you and me and Lisa.
Stick around for more of this, eh?
We'll have a full English. Al will have the coronary.
Is that the promo? That's the promo for our Jubilee coverage. They're going down a street, a familiar one with a big house at the bottom, and then a family comes out on the balcony and, and waves at a flyby.
Oh, John, such a Republican.
Teeing it up in a big way, Tom. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The price of oil is falling today following a pair of reports. According to the Financial Times, Saudi Arabia has indicated it's ready to pump more crude should Russian output decline substantially due to increasing sanctions. Meanwhile, President Biden is likely to visit Saudi Arabia this month. That could lead to an increase in Saudi oil production. Soaring gas prices are hurting the president politically. Sheryl Sandberg helped turn Facebook from a startup into a multi-billion-dollar advertising powerhouse. Now she's calling it quits. Sandberg is stepping down as chief operating officer of Facebook parent Meta Platforms after 14 years. She served as the highest profile face of the company next to CEO Mark Zuckerberg, but she was criticized for the company's failure to rein in large-scale misinformation and privacy breaches. Russia says it's ready to settle claims on bonds that were judged to have breached their terms after missing a $1.9 million interest payment. It's an attempt to avert an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said a failure to pay event occurred on credit default swaps. Russia blames foreign counterparties for that delay. In Tulsa, Oklahoma, police say a gunman killed 4 people at a medical building, the latest in a series of mass shootings in the U.S. Authorities say the gunman apparently killed himself. It's unclear what led to the attack. Police say they were on the scene about 3 minutes after getting a report. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
labor market is the tightest basically it's ever been, and you can see that by the ratio of unfilled jobs relative to the number of people that are unemployed. The Fed needs to loosen that up, or wage pressures will accumulate, and that will keep inflation above the Fed's 2% inflation objective.
That was Bill Dudley, the Bloomberg opinion columnist, and of course the former New York Fed president. On those job openings, one employed individual in this country right now, based on the data out yesterday. From New York City this morning, good morning, futures positive, 0.5% on the S&P. Our attention through most of this morning so far, all over the place. But if you pick a point in the market, it's on crude, 112, WTI, negative 2.7%. Keep going back to those two reports, Tom. One from here at Bloomberg and a team in Washington pointing out we could have a meeting between the President of the United States and the Crown Prince later this month in Riyadh, Saudi Arabia. The other report out of the FT, in addition to what we heard from the Wall Street Journal earlier this week, just this idea the Saudis are getting ready, prepared to do more if we need them to.
You wonder how OPEC Plus is in 3 months or in 6 months. And of course, we all wonder about a gallon of gas as well. We are pleased to bring you on short notice Christian Malek, global energy strategist at JP Morgan Securities. Christian, I want to go to Jamie Dimon's annual report of April of this year, his letter to shareholders, where he talked about the precarious nature of the global energy supply. Simply, that supply is easy to disrupt. We should also keep in mind that as a percentage of global GDP, oil is only about 40% of what it was in 1973, but it is still essential and critical. Mr. Dimon has stated there is some level of hurricane out there. In your 100-page treatise, you don't use the word hurricane, do you?
No, we don't use the term hurricane, or it's a fantastic analogy by Mr. Dimon. In fact, the key here is we look into the future, as we've been really calling for the best part of 2 years. We see a world that is short energy, short oil, well before we no longer need it. And I think when you think about the deficits, whether it's wheat, whether it's energy, it's all pointing towards a situation where basically there will be no solution around mitigating higher prices and particularly higher inflation across energy. We're basically short all fuels, Tom, and the only one that's available that's fungible, even in a limited context, is oil, but that doesn't preclude it moving significantly higher.
At what price Brent crude per barrel does the investment incentive click in with a vengeance?
I think the oil price needed, it has to be over $100 for a sustainable period. I think the volatility of this asset class, the credibility of this asset class, when you've got COVID concerns or recessionary concerns, means that you see a bit of paralysis in the C-suite. Management teams just don't want to press the buzzer on a major project on a sort of 10 to 15-year view at risk of oil prices potentially collapsing. And I think that paralysis means we need a pretty significant risk premium to oil, which I would argue will sit somewhere closer to 120 to 130. So while the fair value could be close to sort of 80, management teams, investors are looking for a pretty big premium in order to qualify. And then, of course, you've also got the pressure from ESG and pressure around decarbonizing, which also doesn't help in the context of investing in long-term projects, because if you do that, you never know whether you'll be in the penalty box in a few years' time.
Christian, given this lack of investment more broadly, is the market right now overplaying the impact of Saudi Arabia increasing production?
Absolutely. We're running to stand still on spare capacity. In fact, adding barrels into a market which could see oil prices continue to stay overheated and as Mr. Dimon mentioned, moving higher over the medium term, could actually end up proving premature. You mentioned the 1970s when Sheikh Ahmed Zaki Yamani had to manage an energy crisis, God bless his soul. And one of the things that we sort of tend to forget, is that when we're at record low barrels of spare capacity as we are now, adding barrels doesn't really help mitigate or help the situation. All you're doing is effectively losing your last line of defense. So I think this is probably where we're at now in terms of it makes very little difference whether you add barrels or not. And that's why I think it's probably likely to sort of keep your powder dry is probably the most appropriate strategy at this point.
Christian, when it comes to Russian output, I'd love your input on this. One factor that your team, some colleagues of yours have pointed out, is Chinese demand for Russian crude, and that if they don't fill the void, step up and buy that Russian crude and keep taking it from somewhere else, we could have even higher crude prices. Can you walk me through the influence of that?
Yeah, Absolutely. I mean, we have a sort of dichotomy between production and exports. Production actually hasn't necessarily moved lower over the past few months. However, exports are very logistically challenged. And I think in terms of the reaction function of the buyer, I'd look at it this way, John. If we move into a higher price scenario, as we're calling for, and we're short even more barrels, and countries need energy, they need molecules of energy, and they can't get their hands on those molecules because they're effectively run out of all other fuels, then that will change the reaction function of these governments towards getting hold of oil. And I think that's an important factor to feature. They may not have any other choice but to secure those barrels in the event that the alternative could mean industrial activity winding down, potential social unrest and so on. So I think, in other words, we should expect elasticity to those barrels in the event that the alternative is much worse.
Walk me through how to play this through the equity market now, Christian. What's the best way of playing this?
The best way to play this is staying bullish energy equities, not the futures of commodities, energy equities, and here's why. As OPEC adds barrels, that is typically bullish. We may see say they do, we could see oil prices at the front end move lower, but historically, adding barrels or reducing spare capacity is conducive to the back end of the curve. That's where energy equities investors live. They live at the back end of the curve. And if they can see and have more confidence the back end of the curve is going to hold above $80, by virtue of the fact that if you look out into the future, there are just so few barrels out there, that means that should give confidence for investors to buy the equities, because equities trade off the back of the curve, and that's where there's been least confidence, particularly around recession risk. So we stay bullish equities and stay bullish companies who are most geared to oil and gas prices to benefit and in turn return that cash back to shareholders. You're seeing a massive return back to shareholders. 30% of market cap in 3 years is unprecedented.
Seen a monster rally as well, a monster rally in this equity market, in that particular part of this equity market. Anyway, Christian, just great work, buddy. As always, love catching up with you from JP Morgan Securities there, Tom, on the path forward, the road ahead for this oil market.
Can't say enough of the report. Get the report, folks. We protect the copyright of all of our guests. Get it from JP Morgan. Whether you agree or disagree, it is the thought-provoking report. It created a hurricane of storm, John.
We turn now to our royal correspondent, Tom King, for the latest on the parade.
It's really interesting right now. The imagery we've got is of the parade, but the Queen has been alone on the balcony. We'll try to get that shot for you here, all by herself. And John, that really speaks volumes about the generational shift here that you and your family have lived.
Elisa, what are you laughing at? It's an important moment.
Is it?
Yeah.
I mean, the Queen's alone on a balcony.
Well,
they're wearing hats on horses.
She's going to be joined by the minions here in a moment, and the royal offspring.
The minions. It's a celebration, guys.
Yeah.
She's not alone. She's actually with someone on that balcony, just letting you know.
Okay. This is where it's at for this coverage, isn't it? The Duke of Kent with the Queen. From New York, this is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City this morning. Good morning on TV and on radio. Here is the Thursday morning price action, about an hour away from the economic data in America. Futures positive by 0.6% on the S&P 500. On the Nasdaq 100 up 0.7%. Yields, that's where I want to take the conversation in the bond market. All this chatter about peak yields, peak inflation. Look to Europe, a German 10-year yield, 120, pushing 123 a little bit earlier this morning. That's the high of the year. We haven't seen the high of the year, perhaps, in Europe just yet, according to Kathy Jones at Charles Schwab. Maybe, though, we're getting closer to it. Your US 10-year, 291. Let's round that one up, Tom. 320 back on May 9th. And all of a sudden, we're having another look at 3% on a 10-year yield.
Yeah, we're not there yet, John. You're right. It's not technically there, but, you know, to be honest here, it has been a leap up. The drama's not there. You wonder where the drama will be Monday morning after the jobs report.
Friday morning, the focus for us at the moment, Tom, 8:30 Eastern Time. Oh, okay. Jobs drop. A little bit later, more economic data. The reaction so far has been pretty clear. The data in America, pretty decent. The ISM manufacturing, a nice upside surprise. Job openings come down, still elevated. The quits rate still speaks to that story. There is a confidence in this labor market. 1.9 jobs open, available for every unemployed person in this country right now, according to the recent data here in the US. The story in the bond market looks like that. In the commodity market, it looks like this. Crude lower. We back away from 120 again, a little bit further. 119.98, the highs of the last couple of days of this week, and then we pull back. The why? Several reports. Started with the Wall Street Journal that maybe OPEC Plus could ditch the plus, push away Russia and come to their own agreement on boosting output. That got a boost from a story from the FT suggesting this morning that that might be what we get from Saudi Arabia. They're set to do more. And then I think the politics important here, Tom. Just the idea from the team here at Bloomberg that we could get a meeting between the President of the United States and the Crown Prince Mohammed bin Salman of Saudi Arabia.
Oh, it would be a big change. I think it's been widely anticipated, and we'll see what happens. John, I'm just getting used to $100 oil. I watch Mammoth Mountain, California, and it's exploded, John, in the last number of days from $6.90 a gallon up to roughly $7.30 a gallon. We've never framed that in America.
We just spoke to Christian Malik of JP Morgan. Very bullish the crude story, very bullish the energy story, very bullish the energy names that produce all of those goods. Tom, Citi take the other side of this, and you know that well.
Yeah, and more.
Citi really take the other side of this, that if we face a real downdraft in economic growth, we have no business, Tom, in triple digits.
Well, it's there. Francisco Blanche scheduled to be with us later today.
Looking forward to that. WTI 112, Brent crude about 113. That's the cross-asset price action. Here's a gloomy full of doom look and some single names. Good morning, Bramo.
Let's talk about supply chain disruptions. Good morning, John.
There we go.
Because that is what we're seeing in Hewlett-Packard Enterprises. It is a hardware and software company, and it came out with earnings yesterday after the bell. They were talking about supply chain disruptions really impeding their full-year forecast. Those shares down nearly 5% ahead of the opening bell. Pfizer is dealing with that shot for kids under the age of 5. For COVID, still, you are seeing a bit of softness there. You have all year, actually, which is kind of interesting given the fact that we still have COVID around here. And Chewy, this is just for you, Tom. 18% gain because they are selling lots of stuff to people who have pets and still have to feed them.
Lisa, part of this is Chewy is the official feeder for the Royal Corgis. I mean, part of it's a Jubilee play. She's got like 14 Corgis.
I'm going to go ahead and doubt that that is true. And
she
I'm going to
pops
guess
PayPal and feeds them with Hills or whatever.
So we're also looking at oil stocks right now, not to discount that in any way, shape, or form, but I wanted to take a look at some of the big oil companies and how they were doing in light of the fact that you are seeing a dip in crude, and it's about a 2.5 to 2.6% loss if you take a look at either WTI or Brent. Actually, shares of the big oil producers in general are not down as much, and that I think is interesting. Occidental is down a bit more than the others, down more than 2%, but Chevron and Exxon down between 1 and 1.7%. John, how much does this really indicate the Christian Malik view of things? That basically this is still the haven, even if you think the city Ed Morse view has some credence. This is the base case, that this is the best hedge against inflation at a time where it seems like commodity prices are going to go up over the long term, despite some barrels coming back online, perhaps from Saudi Arabia.
Elisa, what did Chris Verona, Stratega, say earlier this morning? He said overbought, sure, not over-owned. I thought that was a really important point.
I would agree with that. A lot of people are waiting for the capitulation from the ESG crowd to say, okay, maybe we got to buy these. And they have not seen that fully yet. At what point do you see that to have this this particular component become a bigger one in the S&P than it has been over the past decade?
I have to say, that wasn't that gloomy, Tom. That wasn't that gloomy at all.
Are you disappointed?
No, you know.
Fired up about the Jubilee. You know.
Is she? Yeah. To be honest, Tom, I don't think she is. At all.
Team coverage here. We'll continue to look to London for some of the
honestly,
moments.
They can't wait, Tom. Edge of the Sea stuff, that coverage.
Joining us right now, Megan Green, Global Chief Economist at Kroll Institute and Senior Fellow, Harvard Kennedy School. And very importantly, Dr. Green, is the idea here of using the Queen's English. And you do that, Megan, with the word awkward. You say our awkward response to inflation on a global basis is really interesting. How awkward is the Federal Reserve and Chairman Powell right now?
Well, the Fed's in a tough spot, right? You know, we're facing indicators suggesting that growth is really slowing. At the same time, inflation is way too high by the Fed standards, by everyone's standards. And so the Fed is stuck knowing that a lot of the drivers of inflation are supply side and that the Fed can't really do much about it. So the Fed's having to hike rates and will hike rates to neutral very quickly, which is around 2.5%. There's a ways to go before the end of the year. And then I think the Fed's really stuck. They're going to pause, recognize that, you know, another 200 basis points in hikes is a lot for the economy to absorb in a short period of time, and see where the data is. So I think it's absolute consensus at the Fed, they'll just go straight to neutral. And then I think they're going to wait and see, as the rest of us will have to as well. I have to say, in all of my conversations with investors, there's been a real shift in focus away from just talking about inflation to just talking about growth over the past 2 weeks. The concerns about a recession are really intense among investors and actually, I think, premature. I don't think we're going into recession in the next 12 months. It's the 12 months after that I'm worried about.
Megan, we sense the same thing. Overwhelmingly, the focus is on some of the output data. What did you make of the ISM for manufacturing yesterday? Because not exactly in line with what we've seen from some of the regional Fed indicators.
Yeah, and this is happening. I had an investor sort of rant at me yesterday that all the data is contradictory and they don't know what signal to read out of the noise. And I think we're all feeling that way. But I think the ISM data was fairly positive, actually. It surprised me on the upside and suggests that we're not careening towards a recession. Look, you know, the consumer accounts for 70% of our growth in the U.S. and consumer balance sheets are looking pretty healthy in aggregate. Of course, the bottom quartile by income doesn't look that great. They've burned through their cash buffer. But the rest of Americans have a big cash cushion. Companies also have a huge cash position built up. So even as rates go up in earnings, the risk is all on the downside. It's going to take a while to burn through all of that cash before we really start to see individuals and companies retrench, and that is what drives us into recession.
Megan.
It's also worth pointing out, with the jobs data coming up on Friday, we have 11.5 million unfilled jobs. A tick up in unemployment is the best indicator of a recession. I just don't see unemployment ticking up significantly anytime soon, given how many unfilled jobs there are.
Megan, given all of this, why won't the Fed be more aggressive than people think? Why will they potentially be more patient and hike rates enough and then pause?
I think that the Fed knows that their history in terms of engineering a soft landing is pretty poor. And in the past, every time they have actually engineered a soft landing, unemployment was actually much higher when they started. So it's much more likely that unemployment will tick up this time around, just given that it's around 3.5%. It's near historic lows, as opposed to in the past where unemployment was already higher. They don't want to cause a recession. And that's why they're fine going to neutral. That's just taking their foot off the gas pedal a bit. But once they get to neutral and have to get into actual significant tightening, I think they're going to be a lot more cautious.
Megan Green of the Kroll Institute. Megan, thank you. Looking ahead to payrolls tomorrow. Lisa, 3.6% on unemployment. And once again, looking for a move down to 3.5%. That is your median estimate so far.
So from an economic perspective, it's moving in the right direction. From the Fed's perspective, it's moving in the wrong direction. And this is sort of the push-pull. I mean, Megan's saying that basically they just need to get to neutral and they can wait. Other people saying not so much, including people on the Federal Reserve, actually seeing more urgency to get ahead of this before it becomes more entrenched. And that is the polarity right now for the U.S. Central Bank that I think is important to watch.
Well, we can discuss the Fed's projections, or as Kathy Jones called them, of Charles Schwab. What did she call them? The Fed's aspirations. The Fed's aspirations. They're at 3.5 year-end, Tom. They're at 3.5% unemployment year-end again next year, and at 3.6% the year after that. And what did our guest say on the Fed show several months ago when we came out with those projections? I believe Diane Swonk called it fanciful.
Yeah. Yeah, John, I just think it's a parlor game, and with the uncertainty that we have right now, I just don't even want to go there. I would state, as we've heard from a number of guests this morning, not a small matter is the opening of China. I think that's been underplayed. I know The Economist magazine this week has a real feature there on the ramifications of post-lockdown China.
Outside of the commodity market, Tom, where do you think it's underappreciated at the moment?
The uncertainty that's out there, people put their pants on one leg at a time. There's way too much certitude chatted up right now. I think the number one, the level of uncertainties, plural, is huge, John.
Might be backing away from the shutdown, Lisa. They're not backing away from the approach, though, are they?
No, and this was interesting. The news out of Hong Kong that basically they're starting to quarantine again in the same kind of way. How much does this indicate basically no shift in the zero COVID policy, that perhaps this is a pause in some of those lockdowns, but not taking it off the table entirely?
Front page of the editorial over in China today, Tom. Great achievements have been made in the defense of Shanghai in the People's Daily newspaper. That was the headline.
Maybe it's bad medicine. We'll leave it at that. John, Peaky Blinders, they had the Epsom Derby in there. That's on Saturday. Is that, John, as big as the Kentucky Derby?
Hold on a minute. You've been watching Peaky Blinders?
No, I haven't, but I know you're a big fan. I mean, I just want to know, is the Epsom Derby as big as the Kentucky Derby?
No, we have the Grand National, Tom. That's our big single race, the Grand National. You missed that earlier this year. Can you do a Peaky Blinders accent?
No, I can't.
Yeah, you can.
No, I can't.
Come on. No. Practice in the break and when we come back.
Sterling advances. Pound sterling stronger.
Nice. Euro-dollar a break of 107 recently, just getting back to those levels, 106.95. That currency pair up 0.4%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. The price of oil is lower today. There's a report from the Financial Times that Saudi Arabia is ready to increase production if Russia has to cut back substantially due to international sanctions. Meanwhile, President Biden is likely to visit Saudi Arabia this month. He'll almost inevitably meet with de facto ruler Crown Prince Mohammed bin Salman, who he's shunned so far. That may pave the way for an oil production boost. In Ukraine, the central bank has more than doubled its benchmark interest rate in an attempt to stem inflation in the wake of the Russian invasion. Borrowing costs were raised from 10% to 25%, the highest in almost 7 years. It was the first rate hike in 4 months. Inflation in Ukraine soared to 17% in May. More than 2/3 of the world's population probably have significant levels of COVID antibodies. That's according to the World Health Organization, and that means they have either been infected or vaccinated. Most studies say that people who have both been infected with COVID and vaccinated have the best protection against severe outcomes. And Chase Coleman's Tiger Global Management has now lost almost 52% for the year, according to an investor letter seen by Bloomberg News. Tiger Global's main hedge fund plummeted more than 14% in May. In the first quarter, the firm cut some of its biggest tech losers, but then added others. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The business continues to be the business it has been for the last decade.
And Cheryl ran that very, very well, except for the governance part. That's you always have to qualify. You can't really say anything overwhelmingly positive or overwhelmingly negative about Sheryl Sandberg. She was an astonishingly effective leader who had a major blind spot.
And she's on her way out. And that was David Kirkpatrick, Techonomy founder and author of The Facebook Defect. Overwhelmingly, Tom, the conclusion is that Facebook today is what it is, largely because of the influence of Sheryl Sandberg. The problem is embedded in that conclusion, Tom, is both an insult and a compliment. Depending on what your perspective is.
Our guest is going to help us here, John, but to step lightly here, we're arranging an 82-gun salute for the Queen coming up here in, I think, about 6 minutes at Hyde Park. You wonder, would there be a gun salute at Menlo Park for an exiting Sandberg?
Have you held the stock over the last 10 years since it went public? Maybe, not over the last 12 months.
Did the stock go up because of her?
A massive, massive piece of that aggressive pursuit of ad revenue, Tom, is down to that one individual, without a doubt.
Now, let's advance this topic here and really advance it into technology and media as a whole. We can do that with true perspective from Brian Weiser, Global President of Bloomberg Intelligence. Folks, this is why you watch Bloomberg. You get Kirkpatrick early in the morning, and then Weiser follows on with some brilliant perspective. Who will replace Sheryl Sandberg?
Well, it's an individual named Javier Olivan, but it's clearly not just one person replacing what Sheryl Sandberg had as a role 15 years ago. Her role is, we were just joking about it, is distributed. Her responsibilities were really distributed over the last 4 or 5 years in particular.
I think it's a mystery of how Mr. Zuckerberg runs the shop. It's Elon Musk, 24/7. How does Zuckerberg run Facebook, and what kind of Sheryl Sandberg does he need next?
It's interesting. 5 and more years ago, people like me would have been debating just how much in control was Mark Zuckerberg. Just how much. And because Sandberg did have so much power and authority over so much of the business, the reality is this was Zuckerberg's business. It remains his. And that is, at the end of the day, he has people who are going to execute what he wants to see happen.
There are going to be all sorts of speculation as to why she's leaving now, Brian. She does say that she wants to work more on philanthropy. She wants to more commit herself to her new stepchildren, her family, et cetera. Is there a more marked shift in now Meta that perhaps doesn't jibe with the sort of nuts and bolts approach that she took?
I think they're clearly trying to move into directions that are different than anything she ever worked on. That's for sure. That's not a reason to move on, though. I think there's been enough speculation that I can only say is probably as accurate as anyone else could say it in terms of whether she would have moved on had Clinton won the election in 2016. Maybe there would have been reasons to do something sooner for a bunch of other reasons, because of all the challenges that they had. At the end of the day, I don't know that it's a change of business that's the catalyst for the change. But I think it's clear that Zuckerberg wants to move the business in a different direction. The advertising business, although as important as it is, it's everything from a revenue perspective. From our client's perspective, it's still a really important media partner. But at the end of the day, it's not the thing that Zuckerberg's focused on. He's focused on connecting people for good and for bad.
Brian, do you think that Sheryl Sandberg holds a lot of the blame for emphasizing ad revenue and, frankly, just volume and traffic over a lot of concerns, social concerns, with respect to the influence over entire societies as well as children?
Well, what's the saying? Success has 1,000 fathers or mothers, and the opposite has probably only a few people to blame. No, I think that the consequences are pretty widely distributed. The responsibilities for consequences that we've seen of all the bad things that really have been associated with Facebook over the years are not just one person's responsibility. If they are, you could say it's Mark Zuckerberg's. But there's so many different factors at play. I don't think you could just pin it all on one person.
Brian, the elephant in the room of the last 12 months, if you hold the stock, is the performance of the name. It's been terrible. It's been brutal. Piper Sandler out this morning, cutting the price targets on Snap, on Pinterest, downgraded to neutral from overweight, off the back of what they see as slowing digital advertising spend. Given the headwinds in the industry, what do you make of what's going on at the moment for this name, for others too, exposed to the world that Sheryl Sandberg, ultimately the industry she helped create?
Yeah, I think here the issue is one of expectations, and where do you divide up and distribute the blame for that one? I think the reality is they had this ridiculously strong pandemic. They did so incredibly, so much better than you could have realistically expected. They did catalyze some growth, but I think they capitalized on circumstances that were way outside of their control. The digitalization of the economy during the pandemic was not something that they caused, but they certainly benefited from. So there's that. I think that too few people understand or appreciate just how difficult the comparables were from the first quarter of 2021 when they slowed down to a single-digit growth rate after they grew almost 50% at the size they're at. So there's a mismatch of expectations. I'm sure the company had a mismatch of expectations too, but investors almost certainly did. And that's, I think, where we are with the stock.
Brian, just quickly, what's Alphabet getting right in that world?
Alphabet gets a lot of things right. Well, first of all, they're more exposed to where the economy is at this moment in time, right? There's more of a skew towards services rather than products. That helps. They're less dependent on the e-commerce based revenue that Facebook was dependent on. I think that at the end of the day, though, and maybe this goes to a bigger issue, Google's gone through an extra generation of management. It is not an individually controlled company for practical purposes. It is, has professional management throughout. I mean, yes, Facebook does too, but it's an extra generation deeper, if you will. And so there's just more diversification. They're just better exposed to where the economy is in general.
Brian, wonderful to catch up. As always, Brian Weiser there, the Global President of Business Intelligence over at Group End. Just to go through that Piper Sandler call, Snap and Pinterest cut, downgraded to neutral from overweight. Alphabet, Tom, they called it the star of the show.
John, I just did on Facebook, and this goes with David Kirkpatrick joining Bloomberg this morning to the day they went public, and I had Kudrowski and Kirkpatrick on set. John, Facebook now is down to a 17% return over life of fund per year, and they are 3 standard deviations off the trend. That's, I don't care who you are, John, if you're a CEO, that is unacceptable.
The last 12 months, Lisa, has been absolutely brutal for that name.
You have both the retracement of the pandemic gains, but you also have a lot of companies not advertising as much because they don't have the goods to actually sell, right? We heard this as an excuse for Snap, that basically the supply chain disruptions and the lack of supply has led some companies to pull back with their advertising revenue despite the incredible demand. How much is that going to be a persistent theme?
Futures right now, up 0.5% on the S&P and the Nasdaq 100, up 0.7%. The price action developing as follows, going into the opening bell, and a little bit of economic data later this morning at 8:30 Eastern time. Yields unchanged at 290.58. The trend yesterday pretty clear. Upside surprise on ISM manufacturing. That drove yields higher, treasuries lower. Just this conclusion, Tom, that every time we get a strong data point, this Fed's got more work to do in the minds of this market.
Absolutely, but we've had some weak data points as well. I think it's indeterminate right now, and what we're going to see here in 35 minutes is the beginning of 2 days of data that matters. I mean, there's just no question about it, John.
On to payrolls tomorrow morning. Big focus for us this morning. Crude just about holding on to 112, negative 2.8%. A report here at Bloomberg that we could have a meeting between the President of the United States and the Crown Prince of Saudi Arabia, Mohammed bin Salman, perhaps later this month. A report out of the FT that the Saudis are getting ready to push output up just a little bit more. We'll get the thoughts of Brian Niconuvi very shortly. Heard on radio, seen on TV. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We haven't seen the recession manifest in the macro data yet. So we still think there's a path for the US economy to have a soft rather than a hard landing.
Given these food costs, these energy costs, our falling income, we will be in a recession within the next 6 months.
We have a labor market that's unprecedentedly tight. The Fed needs to loosen that up, or wage pressures will accumulate.
They need to front load these rate hikes as much as possible.
People are worried about these rate hikes, but they're already priced into the market. It's what happens from here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. We welcome you to America in New York on a day of job claims and on to the jobs report this morning. John, we are data dependent.
We are, and we're looking for some more data a little bit later this morning. The ADP report about 15 minutes away, Tom. On to jobless claims at 8:30 Eastern time. On to tomorrow morning, 8:30 Eastern, with a payrolls report and an unemployment rate, Tom, predicted by many to come down to 3.5%.
And what is so interesting is that trend of that to 3.5% is away from what the Fed really wants. Many people talking about a need for a 4% unemployment rate. Most Americans, John, don't agree with that.
Tom, you've seen how this market is digesting the economic data in the last 24 hours. You get a strong data point, the ISM manufacturing, you get treasuries lower, yields higher. We've talked about that conclusion. This Fed has more to do.
Let's frame up the data, John. We've got to go to hydrocarbons here, particularly with Christian Malik joining us in the last hour from JP Morgan. Diamond says it's a hurricane out there, and the hurricane starts with 113 Brent crude.
Yeah, and let's face it, this White House, Tom, has been in the middle of that hurricane for the whole year so far. That hurricane for them is inflation. High crude prices, high gas prices. They want to do something about it. The report from the team here at Bloomberg suggests in the White House, the President of the United States could be meeting with the Crown Prince Mohammed bin Salman in Riyadh, in Saudi Arabia. Tom, I think that is a really important development in the last 24 hours.
And Lisa, what's so interesting here is the unequal application of 8% inflation across society. It's not fair, is it?
No, it hits the lowest income the hardest. How does the Fed deal with that, especially when they tend to get hit hardest also when the unemployment rate rises? Look, this has been a conundrum for a long time, and this was a very socially conscious Fed that suddenly is a lot less socially conscious at a time where inflation is the main issue. And so how much are they going to basically put nuance aside, put divergence within the labor market aside as they say, look, we need to get price stability under control, and that is our first and foremost issue.
Cheryl, I'll get out. 3, 2, 1. Cheryl Sandberg would not know credit if it hit her over the head. Lisa, an update on credit versus full faith in credit.
Honestly, there's actually been a rally. And this goes to this whole feeling that you're going to get not necessarily a soft landing, but the Fed is going to pause.
A better feeling.
A better feeling.
And you
saw that in risk assets
nice.
Generally last week. It's such a nice feeling.
It's a nice move. It's nice.
But honestly, I spreads think was a nice move, wasn't it?
It was such a lovely move. There is this issue, though, Tom, that Megan Green was talking about, that the Fed has taken lessons from previous history and basically will just raise rates to neutral and then wait. Drew Mattis of MetLife sent me a fantastic message basically saying when you miss the bus, you don't jump on a moving one. Basically, they got it too late, and now they're trying to figure out how to catch up, and they have to really thread a needle that's already pretty narrow. How do they move forward?
Now we'll have to see. Data check, how about a large devaluation in the British pound since the beginning of the Queen's reign? Right now, the Queen enjoying, John, a 125.54 on pound sterling.
A nice move in its equity market again, Tom. Up 0.5% on the S&P. Lisa keeps saying that every morning. Nice move. The Nasdaq up by 0.7%.
Okay, can we set the record straight?
Please do.
That you were the one that said nice move.
I don't remember
and
being
I
that
laughed, and I laughed, and I said nice, so nice. And now it's my commentary?
Yeah, you thought it was a nice move. No? You didn't think it was?
Show's come to a complete halt.
Tom, I'm confused. Did you not think it was a nice move?
Let's save the show right now, folks. Give me some Jubilee action here. Come on, Amy, cue it up. They're doing a flyover here. They're landing at Heathrow, coming in with British Air right now. And, of course, the royal family and the royal offspring, John, on the balcony.
The working royals, Tom. I believe we're going to have a flyover of 70 aircraft
right now.
for every year of the Queen on the throne.
And with that little kid.
Exciting stuff,
Charlotte,
Tom.
Louis, they're all wearing Rachel Riley this morning. They're styling.
Packed outside of Buckingham Palace, Tom.
Packed, thank you. There's your Jubilee coverage here with Prince Charles. The Duchess of Cambridge, and this is the wave I'm going with, John. It's been working all morning.
The royal wave.
The royal wave.
You've been practicing that, haven't you?
I'm taking this off of the Duchess of Cambridge.
People often reach out to me and talk about how much preparation do you have to do? And I'll say, well, Lisa and I do a lot of reading. And I know what you were doing this morning in the mirror. Just
practicing. Well, the Queen Mother would do this, on radio. This is really working on radio, but I was going to go with the Queen Mother look. Seriously.
Tom, the Italian influence in my family, that kind of meant something else. That's how I grew up. It wasn't this, it was...
Would you like to add any more to the Jubilee? Remember, the offspring are listening. You are so done. We will continue here with the pageantry. We thank Queen Victoria Street for their services this morning and covering a moment for Queen Elizabeth II. Brian Nick is like, when do I get some airtime? Joining us now, Chief Investment Strategist at Nuveen. Brian, in equities, people are trying to guess a bottom. In the bond market, how do you guess a bottom which leads to price up, yield down?
I think really what we need to see is what you were just talking about, which is the data coming in that's strong but not too strong. The more of these numbers that we get that show that the economy is slowing but not cratering, not crashing into recession, just sort of normalizing, the better that's going to be taking pressure off the Fed, taking upward pressure off the 10-year, and that is sort of the release point for relieving stress on the equity markets, credit markets, and we know what happens to Fed funds futures as well. We start to see a little bit of a downward move there. Maybe some of those 50 basis point hikes from later this year getting priced out, looking more like 25 or maybe even a pause. And that is the release valve on the pressure that I think is what's going to mark, again, the top for the 10-year and the bottom for the S&P 500. We may have already seen it, but I think the more data that we get, like the ISM yesterday, the JOLTS data yesterday, the more work, as you said, the Fed's going to need to think about doing with rates.
Brian, I'm trying to stay open-minded about this, and I look at the economic data at the moment. There seems to be something for everyone. You mentioned the ISM manufacturing and the job openings. Others would point to the regional Fed prints, and they would say that things aren't as strong as they seem. How do you put together that contradictory economic data we're getting in America?
We have a conflict between the soft survey data right now and the hard data, what people are actually doing, businesses and consumers. I always default to believing the hard data, but I think job security is really the name of the game here. I think it's not just the job market, the unemployment rate, the JOLTS openings. How secure do people feel in the job they have? Because frankly, most people who want to be working are working and probably have gotten a little bit of a pay bump, but again, are paying higher prices at the pump, are paying higher rents. What gives them the confidence to continue spending X gasoline on everything else and keeping the economy moving? It's in the JOLTS data yesterday that we saw, very few layoffs and sort of involuntarily separations still ongoing. If we see destruction in job openings but not in actual job creation, I think the consumers carry us through, because if you're relatively comfortable that you're going to be able to stay in your job, even if you're not going to be able to easily find a new one, you're probably going to keep spending, and the savings rate can continue to come down. The accumulated savings that people got during the pandemic can continue to wind down and keep this economy moving.
From a market perspective, Brian, is this a good or bad thing that the consumer still has a lot of cash still ready to go?
It's definitely a mixed bag, but I would say it's a good thing for now that the Fed is deliberately raising rates quite quickly towards some semblance of neutral. We'd much rather have consumers have cash on the sidelines than not, but that's not true across the board, obviously. If we look at the lower end of the wage scale, these are people where I think wage growth has been typically better in these types of jobs, but the accumulated savings during the pandemic has probably been spent much more quickly, and we're seeing people dip into borrowing and dramatically lower their ongoing savings rate. So it's a mixed bag across the spectrum in terms of what the consumer looks like, and this is one reason why we prefer to be in the U.S. economy, exposed to the U.S. economy versus other places where food and energy prices bite a lot more, and you haven't seen the wage increases to match the price increases. So in Europe, they haven't had high wage growth. They've had the same kind of inflation we have. That means their consumer, I think, is going to come out of this, or has already come out of this, a bit weaker than ours here in the U.S.
Brian, let's wrap it up by getting to the market call. JP Morgan's Marko Kolanovic said this yesterday: despite the steep sell-off, we believe that markets will recover year-to-date losses and result in a broadly unchanged year. What has to go right for that to happen? And is that something you can get behind?
I really want to believe that view. I think that would make me an optimist at this point. We're down 13 or 14%. To see that rally over the balance of the year on the S&P and get back to flat would be wonderful. I think what probably needs to happen here is you need to get the sort of threading the needle from the Fed, probably 50 basis point hikes over the summer and then decelerating to 25 or nothing by the end of the year, and not having that happen in the context of a dramatic weakening in the economy. So continued fall in job openings, continued job creation, job security for people who have those jobs, rising wages, and falling gasoline prices would be nice, but it doesn't seem like that's going to happen in a dramatic way anytime soon. I think that's what gets us to the confidence. I think we get to that September hinge point where the Fed can take its foot off the brake just a little bit. I think that's when the market rally can really begin. But we've already seen it. The credit markets are behaving better. We think that might be sort of a half measure for investors that want to get in a little bit risk on, but don't want to be taking the full risk of being exposed to another equity downdraft. Credit markets at least are paying you a coupon while you wait for that to happen.
Brian Nick of Nuveen with an elegant way of saying no. Lisa, it's going to be very difficult to get that money into you. That was beautiful. I like that. Was that a slap for me, though, or was that?
That was.
Was that the wrong way? Which one was it? I like that.
A royal
Get our guests to do that for the next few days. That works out, Tom.
Yeah, it works out good. John, an important note here. Current foreign exchange tells you so much. John, sterling to dollar. We all know there's been a devaluation of pound sterling, 280 down to 126 over the span of the Queen's, from the coronation, I should say. Look at Swiss franc, John. It's a different number set, but from 12.24 down to 1.20. What does that say about the strength of the Swiss franc?
It says a lot about it, Tom.
Wow.
Just wow. And an S&B who definitely wants to see it
go
the
okay
other
on
way.
that, John?
I thought it was beautiful.
I did
Wave
for
or the
Boy
FX
George.
analysis? Which one?
Yeah.
Wave. You want to wave us out?
I'll wave us out.
Wave us out, Tom.
Although Boy George is doing the clapping with his mother, the Duchess of Cambridge, so we can clap.
That's too close to the Communist Party.
True. No, that's more like this.
Elbow, wrist.
Is that Politburo?
That's more
clap together.
Party
That's
Congress.
North Korea.
When
right?
we go to Shanghai for the Party Congress, John, the three of us on the balcony of the Peace Hotel, we'll be doing this.
I'm fairly confident that's not happening.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The price of oil is falling today following a pair of reports, according to the Financial Times. Saudi Arabia has indicated it's ready to pump more crude should Russian output decline substantially due to increasing sanctions. Meanwhile, President Biden is likely to visit Saudi Arabia this month. That could lead to an increase in Saudi oil production. Soaring gas prices are hurting the president politically. Sheryl Sandberg helped turn Facebook from a startup into a multi-billion-dollar advertising powerhouse. Now she's calling it quits. Sandberg is stepping down as chief operating officer of Facebook parent Meta Platforms after 14 years. She served as the highest profile face of the company next to CEO Mark Zuckerberg, but she was criticized for the company's failure to rein in large-scale misinformation and privacy breaches. Russia says it's ready to settle claims on bonds that were judged to have breached their terms after missing $1.9 million in interest payments. It's an attempt to avert an insurance payout potentially worth billions of dollars. The Credit Derivatives Determinations Committee said a failure to pay event occurred on credit default swaps. Russia blames foreign counterparties for that delay. And new data suggests that U.S. housing supply hit a turning point last month. According to Realtor.com, home listings increased for the first time in almost 3 years. The number of active listings rose 8% from last May. Still, listings remain more than 48% below their level 2 years ago. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Runaway inflation at the gas pump and at the grocery counter has been the lead indicator for recession of the last 6 recessions in the United States. If the United States is not currently in recession, given these food costs, these energy costs, our falling income, we will be in a recession within the next 6 months.
Stephen Schork there of the Schork Group, the president on this crude market and a whole lot more in this economy. Good morning to you. Equity futures are positive by 0.4%, about a minute away from ADP data. We'll get to that in a moment. Crude 114.59, erasing some of the losses this morning, down about 0.6%. Want to go through things piece by piece if you're just tuning in. We had a report from the FT suggesting that Saudis could be ready to boost more. A report from the team here at Bloomberg suggesting the president could meet with the Crown Prince Mohammed bin Salman later this month. And then moments ago, this headline, OPEC Plus to discuss adding 600,000 barrels a day to the oil market in July, according to delegates. This proposal, Tom, against a scheduled 430,000 a day increase. So that's some of the news, just kind of dripping out of this meeting today.
And I blended in, John, again to Bloomberg Commodity Index, which is very good math, is up nicely this morning, not quite to the middle of April new highs, but those indices blended oil and away from oil are frankly quite they're pushing up to record highs.
Clearly this market wants to see more from this cartel. Crude right now 114.45. We're down 6 or 0.7%. We've got an ADP report, Tom. It is a downside surprise. 128,000. The estimate 300K. The previous number 247. Setting us up kinda for payrolls tomorrow morning. Kinda. 325, the estimate going into tomorrow. The previous number 428. So Lisa, that's a downside surprise on the ADP report.
Do we care? Does anybody care? Does anyone trade on the ADP
You kind of alluded
report?
to that earlier this morning.
Honestly, ADP data has been incredibly volatile, and people tend to not really trade off of it, which is the reason why it's very hard to read. Are people going to try to make something of this? Sure, because they're looking for data, and they're saying they're data dependent, and so this is data. But honestly, I'm sorry to point this, but honestly, what correlation has there ever been between ADP and jobs report?
I don't think you have to apologize for anything. I think most people listening to everything you just said, Lisa,
apologize to me,
would probably agree with you, would agree with everything you've just said. Well, we've got to work out, though, if we get that kind of downside surprise tomorrow, is that an indication of weakness or just the fact the labour market and the gains are going to mature anyway, Tom? Is that what we should expect? Should we be more focused on what happens elsewhere with unemployment, with wages?
Elsewhere, I'm going to look at wages, and what I'm going to look at here in 14 minutes is unit labor costs. It's a goofy part of the productivity report. I know it's dated Q1 and all that. I'm sorry. I'm going to look at unit labor costs to see how they adjust.